Got to be old enough to know what I'm talking about there. Says it's in its best financial health in decades. Sales rising quite nicely across the board.
Okay, that's certainly one to watch. We've had some quite upbeat commentary coming through from some in the retail sector, all about that real wages story, though. We talked about that with our economist in the first hour of the programme and how much that matters right now, but will fade later in the year is the Investec view. We're just getting these European markets open then this morning. In terms of where we are on the European trade, the FTSE 100 out of the gates and flat. So we're digesting the corporate earnings stories here in Europe, but also waiting for the Nvidia story. Down 0.1% then on the FTSE 100. Other markets just yet to open, down 0.4% on the FTSE.
I'm watching the UK 2-year climb. Drop, yields climb.
Yes.
So we're currently up, there we go, 11 basis points, 12 basis points. So a fairly significant reaction. I think we've already anticipated this given the repricing we are seeing around the Bank of England this morning in the swaps market, but we're up by 12 basis points at the front end of the curve. Other markets across Europe, we're seeing the front end move there as well. So the UK is having an effect on other bond markets.
It's moving twice as much as the others, though, isn't it? At that sort of...
Understandably.
Yes.
Yeah. The market's very sensitive. In some ways, the governor of the Bank of England was right last night when he talked about a substantial drop. This was a substantial drop, just not quite as big as anticipated. The market's super sensitive to even relatively small misses, but maybe it's the service data that I think is catching everybody by surprise this morning and how little it has dropped.
Yeah, well, and the argument there was just simply this is more of an energy story at the end of the day that's driving the story, which brings us right back to the equity market, because look at what your underperformers are this morning. Your Shell, your BP story, even your Glencore, although the bond market, of course, does matter as well. Which again, I'm macroing all of this. I'm waiting for this to show up in some of the UK banking stocks as well, because when you see this kind of yield move, you should see the likes of Barclays, for example, Lloyd's rallying, and right now they are still underperforming.
Because rates stay higher for longer, therefore net interest income stays more sturdy than it would have done otherwise.
Yeah, and we're not seeing that tick higher just yet.
In terms of where we are on the sectors picture then, we've got banks, the best performing sector, media, technology, but this isn't a great session. It's not a classic. We're down, a 0.25% on the stock 600, but only four sectors, in positive territory. Everything else is negative. Autos and parts, actually, the worst performing sector this morning, down 0.9% there. Some weakness coming through, Stellantis, VW, Volvo, and the like. So it's autos and those parts suppliers trading weaker this morning.
SSE is the biggest the second biggest loser on the FTSE 100 this morning, down by 1.9%. The numbers actually look fairly good and are certainly above expectations. However, it may be the lack of guidance into 2025 that's causing a little bit of concern this morning. But that stock has come down, 1.9, nearly 2%.
A really interesting dynamic. We're going to keep an eye on this equity markets as well. There's a lot to digest here, but let's bring it back out to the broader picture. We were speaking to Ida Liu of Citi Private Bank yesterday, talking to us a little bit about what the allocation actually looks like. Where is the entry point in this market? Take a listen to what she had to say.
It's more important than ever to construct very thoughtful, globally diversified portfolios for clients, just given some of the risks that we're navigating on behalf of our clients. So on the one hand, we have been leaning into locking higher rates for longer, right? Extending duration on fixed income as one way to sort of hedge out some of the other challenges. But on the other hand, we've been leaning into equities more so than ever because we see that there's an opportunity, particularly in small and mid-cap companies.
So the equity market is rallying all over the world, and yet there are still opportunities, but perhaps in the different parts of the market than we traditionally look at, the small, the mid caps. That's the view, at least, of Ida Liu over at Citi Private Bank. Let's get another insight, another perspective here. Joining us now this morning, John Bell, portfolio manager in the equity income team at Newton Investment Management. Pleasure to have you on the program. Good morning.
Good morning.
Talk to us about how you view what Ida just said, the small mid cap story. She was talking about it in the context that this market is actually looking far broader than it did just 12 months ago last year. Your view on entry points into this market on both sides of the Atlantic?
Yeah, I think breadth is key. So we run an income portfolio, not necessarily focused on small and mid caps, but we are interested in breadth because the market has been so concentrated, so driven by large cap stocks, particularly in the US, and very much with an emphasis on growth. We run an income fund, so it's almost a quality value type of portfolio, so nothing to do with what's been driving markets. And that breadth that is starting to come into markets is therefore very interesting to us.
How much of that breadth is really fundamentally driven as opposed to buybacks and dividends driven?
So the growth in dividends, I think, is both fundamentals and the structure of the businesses. But I think what's really interesting for us is the potential for a rotation creating breadth. We've never seen such a narrow, concentrated market, so dominated by such a small handful of very highly valued companies.
Yeah.
The opportunities are in, as you've touched on already this morning, other parts of the market where valuations remain attractive. So headline markets can go somewhere driven by big companies, but underneath that, then there are lots of opportunities still in our view.
Good morning. You run an income fund.
Yeah.
You think income stocks are cheap.
Yes.
What is the catalyst for making them not cheap?
Yeah, I think that is a great question. And historically, we've been very confident about what could change things. I think now it is concentration, it's valuations, which are extremely high, and just positioning. And I think potentially as markets really...
When you say valuations are very high, you mean growth stock valuations are very high?
Exactly right.
Right.
Exactly right. And I think, we've been talking a lot about the inflation numbers this morning.
Yep.
That zero interest rate quantitative easing period following the financial crisis we would characterize as the era of free money.
Yep.
That was a great time for growth stocks because of discounting at the bond yield. That's what creates the value of a growth company. Now, as the market realizes, I think that inflation is much more of a longer term factor, rates higher for longer, then that can be the catalyst for valuation.
So equity markets have to wait for the bond market to recognize that rates are going to stay high for longer. Is that the catalyst?
The bond markets are there, aren't they?
Are they there?
Bond yields are significantly higher than they have been for a long period of time. Yeah. So I think it's just a realization that they stay there rather than necessarily go higher.
Good morning to you, John. So that's the dynamics in terms of equities in the bond market. You run an income fund, which makes me think about the UK and what's happening here in the UK. We talk a lot about certain businesses thinking about moving their listing, going somewhere else. How much do you spend time at Newton thinking about that, and how do you make sense of the conversation around a sort of a UK discount on stocks?
Yeah, we tend to think more about sectors and stocks than particularly geographies. But having said that, we run a global portfolio, and relative to the benchmark, the UK is our largest overweight. And as a generalization, and I'd probably categorize this across Europe actually, global companies listed in the UK and in Europe are cheaper than their US peers. As a result, global companies listed in the UK consider moving to the US because they get a higher valuation, and we have seen that happening. From our perspective, that doesn't matter too much where the company is actually listed, where it's domiciled. What we're interested in are its prospects relative to its valuation.
And where do you stand on, we talked earlier about some of the things driving inflation, and one of the concerns is around trade tariffs. And how are you thinking about that, and how that's going to factor into your asset allocation in the years ahead?
Yeah, absolutely. We think about the world very much in thematic terms at Newton, and we divide those themes into macro and micro themes. And one of the key macro themes is great power competition, the battle between liberal democracies and autocracies, and perhaps at its simplest level, the US versus China. And the trade tariffs are very much part of that. If we think about politics in the US, there's not a great deal that the two parties agree on, but bringing back manufacturing to the US, strengthening the US economy, is one that they definitely do agree on. And tariffs from the particularly China will be something that is very much part of that. So yes, we absolutely have to think about that, and very much part of our thematic backdrop.
John, if I look at the top 10 holdings that you've got right now, CME, Sanofi, Medtronic, Samsung, Dominion Energy, Cisco, PepsiCo, Johnson Controls. Talk to me about the themes that link those stocks. Why are they all up there in terms of the big holdings that you have? And what kind of an environment do you think those stocks are built for?
Yeah, you would look at it and you'd think this is a portfolio that is full of stability. It's built for a more difficult economic backdrop. I think we and many people have been surprised by the resilience of the global economies in the face of much higher rates. But we continue to have a portfolio which emphasizes stability. CME, Chicago Mercantile Exchange, that is all about volatility in bond markets. That is about the macro environment, the uncertainty, inflation staying higher for longer, where are rates going, volumes going through bond markets. Otherwise, it is about just really undervaluation. Sanofi, the need for innovation, the need for greater spend on healthcare with aging populations, challenging demographics. We can get exposure to technology running an income fund. We don't own any of the Magnificent Seven, but Samsung Electronics, from a memory perspective, AI needs memory. So there are plays for an income fund in that space, but overall, very negatively exposed to growth.
Let's talk about one specific holding that you had on that top 10, the CME.
Yes.
You said it was a bond story, volatility story. There was a report a couple of weeks ago that the CME is looking to get into Bitcoin trading in some way through a Swiss kind of mechanism. They're still working out the nitty-gritty of it. We also know that the CME has backed different types of commodities exchanges globally. One that I think actually Jeff Curry, the former head of Goldman Sachs Commodities, is on the board of, ABAX Technologies. How successful can that be? Is this a proper way to go when you're looking at a world where commodities, Bitcoin, if we're going to include in the commodities basket, is such a volatile, almost scary place for a lot of investors to go? Is there really appetite for that kind of investment?
Well, I think it's about trading, isn't it, really? It's about people trading in these commodities, trading in fixed income, trading in Bitcoin. So someone facilitating that is in a different position from someone who's absolutely, encouraging. Exactly right. So it is about being the intermediary. It's about using your technology to benefit from volatility and from trading activity. So I think diversifying the business into areas where there is a lot of trading is definitely the right thing to do.
You don't see market crashes, for example, or anything as a risk to that, like retail involvement, for example?
Well, in terms of what? Being predatory in some way on retail investors?
It can go wrong very quickly and hold the market maker responsible, no?
There is reputational risk, but at the end of the day, if you're in the intermediary space, then I think you should be relatively protected.
We're all in the volatility business.
Exactly.
John, great to see you. Thanks for stopping by and seeing us. John Bell, Portfolio Manager at Newton Investment Management. Thank you very much indeed. Quick look at the Core 6 here in Europe, just to give you an idea of what is happening. Keep an eye on Schneider this morning. The Bentley acquisition looks like it is no more. So that stock certainly reacting to that in a positive way. But broadly, European equity markets drifting a little lower this morning, and some of the big cap stocks certainly a big part of that. Interesting to see ASML a little bit positive, though, going into the NVIDIA numbers. But broadly, we are seeing some weakness across Europe. That's picked up a little bit of speed. Let's get some more details on some of the other stocks that we're watching so carefully this morning. Joe Easton has all the details.
So Marks & Spencer's really saving the day for UK stocks at the moment. We're up around 8% at the moment as they report that big increase in sales growth. The food business outperforming home, but home also doing pretty well. It's their 12th consecutive quarter of sales growth, and that is leading the gains in the UK and actually lifting Ocado as well, though that one actually ticking slightly lower at the moment. Bit of volatility in that one. That is their joint venture partner. Also some positivity in Tesco's as well. Next, slipping very slightly. But the big thing today is, of course, this hot UK inflation data. We're seeing the rise in gilt yields this morning, and that is weighing on a number of sectors in London at the moment, in particular the home builders, the weakest sector in the UK at the moment. We'll take a look at a couple of those stocks because it is red across the board at the moment. Barratt Development, Taylor Wimpey, Persimmon, Bellway, all of those coming down. Now, interesting to note, we will actually get another CPI reading before the next Bank of England decision, which doesn't come until late June. But even so, the market reacting to this and reducing their forecast for rate hikes, and that is weighing on your home builders this morning. Then in terms of another sector in focus, we're over in Germany looking at autos following these headlines that potentially there could be more tariffs from the Chinese on the auto sector. Potentially 25% is a headline that we're seeing, citing some of the earlier European Union reports as well. We're seeing Mercedes down 2.8%, BMW falling as well, Volkswagen, Porsche, all of them getting hurt on potentially more concerns around tariffs. So that is a weak spot in the European market. Then in terms of miners, the countdown is on. BHP has around 9 hours left to make a final firm bid for Anglo American in the put up or shut up deadline under UK takeover rules. We'll wait to see if we get any headlines on that. Copper prices are weakening today as well, so we're seeing some declines across those, but the big thing will be Anglo and BHP. Will we get a statement from them? We'll wait to see if that comes out, but we would expect something might hit the wires later today. In terms of Schneider Electric, you mentioned earlier there, Guy, that one did see a bit of movement at the open over in Paris. Very slightly higher, potentially some relief that they won't be doing this massive deal for Bentley Systems over in the US. We'll keep an eye on that one in the pre-market. New York trading set to be a bit of a decliner. Finally, we'll look at a couple of earnings. British Land had some numbers out that might have been a bit higher if it wasn't for that UK inflation data. The earnings look pretty strong. Scottish and Southern Energy, SSE falling. Bit of concern around their wind energy business is what the headlines are suggesting. Swiss Life got some earnings out of them. The assets under management are declining. And in the biotech space, Evertech over in Germany, that one gaining a little bit following their results today. Finally, just one morning call to bring you is DSM. This is a maker of nutritional products. They're spinning off their animal nutrition business, and Morgan Stanley likes this one. All those pets getting their nutritions, and that is upgraded to overweight over at Morgan Stanley, and that one's gaining 1.6%, 132 price target. Lots of upside on that one, and it's gaining this morning up almost 2%.
Joe, thanks very much for the update. Joe Easton from our equities team with all of the movers this morning. Coming up on the programme, we'll get to another stock that is on the move. It's sliding slightly. We'll have an interview with the CEO of the British Power Generator, the largest renewable energy business in the UK, largest renewable electricity portfolio, I should say, in the UK. SSE's CEO joins us shortly. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing the World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
18 minutes into the equity market session here in Europe. As you can see, a little bit of red on the screen. It's not a lot. We are waiting for the Nvidia numbers a little bit later on. I think as a result, equity markets to a certain extent are becalmed this morning as we wait for those numbers from the chip giants. We are seeing a certain tick up when it comes to UK front-end yields as we factor in the inflation number that we have seen this morning. That inflation number brought, though, largely lower in the big picture as a result of energy prices that have come down fairly sharply, which brings us on to our next conversation. SSE, Scottish and Southern shares down this morning, a little lower this morning. This is the power generator, which has the largest renewable energy portfolio in the UK and Ireland. Beat estimates for the full year earnings, but didn't give us full year guidance. 2025 guidance as well is something that the market was maybe looking for. We're joined now by Alistair Phillips-Davies. He is the CEO of the business. Good morning, Alistair. Thanks for taking the time to join us. A couple of things I just want to bring up from the get-go, really, and just get your clarity, get some clarity on. Why no guidance going forward from here? What kind of prevents you maybe from giving us a clearer picture of what is going to happen next? And just talk to us a little bit about what's happening with Dogger Bank, which is this offshore wind farm that is being developed. Looks like it's being pushed out a little bit further. Just give us some clarity on both of those two issues.
Yeah, morning, Guy. Nice to speak to you. So on guidance, what we've done is given a lot of detailed guidance around the individual business units. So we'll see thermal generation definitely down as gas prices and volatility has come down. But against that, renewables, which are strongly up this year, 36%, will be going up again in the year looking forward. And we also see networks, particularly on the distribution side, moving forward in the coming year. So there's a bunch of detail in the release that I think people will get to ultimately, and that'll give them a good view of where we are. On Dogger Bank, we're a long way through Dogger Bank A, but we have had some teething problems. One with installation rates, particularly being difficult over the winter because of weather. That's why those wind turbines are out there, where the weather is a little bit more severe and windy. And also one blade installation that gave us some problems earlier in the month. But apart from that, we've got 16 turbines up and either fully or partially installed, with the rest of the blades going on to those by the end of the month. And we're looking to get to a rate of 10 per month. So that's why we think we'll hit early next year in terms of getting that online. And also returns from that project are still in line with where we guided the market way back, so 3 years ago when we went to financial close.
Alistair, one of the things that we're talking a great deal about this morning is the inflation data we've seen on our Bloomberg terminals. That inflation data has come down largely as a result of what we've seen on energy prices. Do you think that trend continues? And do you think it's something that we can continue to rely on? Or do you think we're going to see more volatility around energy prices?
So I think that's right. We've seen prices come off significantly in the market since December last year, probably leading up until roughly the end of March this year. We'll also see a print for the Ofgem price cap coming out on Friday, and I've seen numbers between a £70 and £100 reduction for consumers. That's clearly good news for them. I think going forward with energy prices, we've definitely seen a bit of an uptick that we talked about earlier on. And I think going forward, there's probably the risks are slightly more to the upside, particularly going into the winter. You've got weather effects like the El Nino, La Nina. Often sees colder weather over the winter. So I don't think prices are going to lurch down from here, but it's obviously excellent news that prices have come down for consumers. And despite that, we still feel very confident in the business model we have and in the ability to deliver profits going forward and out to our financial year 27 forecast.
Alistair, good morning. There seemed to be some line of thinking this morning that perhaps some in the market are a bit disappointed by what you said about SSEN, the transmission business operating in the north of Scotland. Profits from that business dropping, and a suggestion then, some guidance there, that operating profit will be lower than the prior year as a taxation benefit is worked through. What do we need to know? What's material around that business?
Yeah, I think the going forward piece is really technical because we've now got full expensing, which is fundamentally a benefit to the company. Within transmission, you'll see a drop in the income in this coming year, a small drop. But going forward, the key thing is that investments that total £2.5 billion this year for the company and will be heading up towards £4 billion are going very, very strongly. And indeed, the transmission business secured £20 billion worth of investment for the latter half of the decade. We'll see profits grow strongly in the transmission business over the next few years. It's merely a technical factor about tax.
Okay, so that's the technical factor in the very short term, different in the medium term. Can I ask you about the policy environment, the political environment then, because you're dealing with the SNP's policies around renewable energy, possibly an incoming Labour government if the polls are to be believed. Alistair, how do you navigate that? What consistency can you expect as you make your investment plans?
Yeah, I think that's a really good question. What we see across the piece is whatever colour of party or government is in, whether it's in Westminster or Holyrood, there is broad agreement about where we need to go. We need to invest significant sums of money to make sure that we keep energy prices lower and less volatile over the longer term, and we get a green benefit. And on top of that, we can also create jobs. So just last week, we saw a groundbreaking of a new Sumitomo cable factory in the north of Scotland that'll support one of our big transmission projects. I think, specifics, I think with the change of leadership in the SNP, I would hope that we'll now see some stability, and we'll see moving forward on things like Berwick Bank, which will be the world's biggest offshore wind farm. So planning consent there this summer would be a real boost. The £16 billion project, 4,500 plus jobs created in Scotland. And I think in the south, whether it's 2035 or 2030, any government or incoming government that shows ambition to want to invest, to want to create jobs, I think will be supportive for us and also good for the general economy in terms of stability of energy prices in the medium term.
Alistair, we're all slightly on tenterhooks. We're all slightly obsessed, to be brutally honest, about the NVIDIA numbers that are going to be coming out a little bit later on, which takes me to the AI conversation that we're also focused on at the moment. How constrained do you think the development of AI servers in the UK ultimately will be as a result of just not enough electrons simply to power them? How constrained do you think we're going to be, and how big an impetus is this going to give your business over the next few years?
Yeah, so I think that's a really interesting one that a number of other people have commented on. I hear work that's been done that indicates an AI search takes about 10 times as much power as a non-AI search. That's obviously going to drive investment if we move in that direction. I think, for us, we've definitely seen an uptick in interest from the big data companies, the big tech companies. We ourselves announced a deal a couple of weeks ago, a big deal in Ireland with Microsoft, and certainly Ireland, which has a greater preponderance of data centres, has got significant power challenges coming up over this winter and the next couple of winters with building emergency generation. So I think that may well be a theme that we see more widely across the UK and Europe.
Great to speak to you this morning, Alistair. Thank you very much indeed. Alistair Phillips-Davies, the CEO of SSE. Up next, we're going to carry on the conversation. Claire Playdale-Bouvray is going to be joining us. We are going to be talking NVIDIA. That's next. This is Bloomberg.
top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
AI is everywhere except in the numbers. NVIDIA has been the big winner so far. There haven't been a lot of other big winners on the spend. There's a lot of spending going on, but it hasn't trickled down in a way that's rising the whole tide, right? So there's a lot of AI dollars out there, and they're being captured by various businesses. But what's been surprising to me is that the overall IT spending is sort of flattish to down.
Morgan Stanley chief U.S. equity strategist Mike Wilson talking about that AI spend, saying it's everywhere but in the numbers. Wall Street, of course, betting on a blowout quarterly report driven by artificial intelligence leader NVIDIA later today. It's the macro and the micro event of the week. The stock closed at a record yesterday as investors look for evidence that the chip maker can actually maintain the explosive growth it's been seeing in its share price. Joining us now, Claire Playdell-Bouverie, fund manager at Lion Trust, who of course has NVIDIA as one of his top holdings, joins us this morning. Now, we're going to get into the nitty-gritty. I hear Guy has some very nerdy questions to ask you. I'm curious about it from a liquidity perspective. NVIDIA stock has rallied. They're sitting on massive amounts of cash. We're talking a lot about AI and the fundamentals and when we're going to see an actual return on all of this investment, because the time frame seems a little hazy here. How much of the NVIDIA rally is really a liquidity story as opposed to a fundamental AI short squeeze story?
Morning, it's great to be on again. I mean, when we're thinking about the ROI on this accelerated compute build-out, it's actually very compelling. So if I'm a cloud service provider investing, say, $1 billion in a data center fit with NVIDIA AI kit, this translates to around $4.5 billion over a 4-year time horizon. So that the ROI is very compelling. And when we think about what's drawing that through from an end user perspective, it's the ROI from this AI software. In Microsoft Copilot, this really blew us away. Gartner have done some fantastic research on this. But the ROI for Microsoft Copilot is 1.5 days. So you invest in Microsoft Copilot, you get your money back after just 1.5 days and some. And it's this immediate productivity uplift that we all as users experience that is really catalyzing this arms race by big tech to build out the AI infrastructure. I mean, we see $3 trillion in AI infrastructure spend over the next 3 years based on this demand pull.
So that's the AI story then. We had Matt Bloxham of Bloomberg Intelligence there saying that there's this potential for NVIDIA to expand even further, going into CPUs, for example. What does that possibility look like, given its transition from being a gaming company to, or gaming chip company to a AI chip company, basically, has been so enormous and so fast and so speedy? How quickly does that broader expansion happen?
So we are seeing NVIDIA already really extend its position up and down the technology stack, innovating to really just continue driving down the cost of compute. And this has involved venturing into CPU territory. We think about the Blackwell, which is NVIDIA's newest computing architecture, ramping in the second half of this year. It's using ARM CPUs within that, but this is all part of a much broader innovation. This super chip has got 72 GPUs, 36 CPUs, all capable of acting as one giant GPU. So it's a long sort of a leap that NVIDIA has come from its historic days as a gaming company. But we do continue to expect to see NVIDIA really push the limits of innovation around the entire stack. This includes software, hardware. They're doing a lateral move into custom ASICs. Their product innovation velocity is just so far ahead of competitors that really no one else is capable of this vertical integration expertise.
And that's probably, and that sounds great and impressive. I wonder if new product is coming so quickly, and I'm thinking here about Blackwell, does it mean that customers have more reason to pause and not buy the current stuff if the new products come so quickly and they'd rather just wait another 3 months, 6 months? And that seems to be where some of the news coverage around AWS and its demand for chips from NVIDIA has come from.
Absolutely. So, I mean, the key debate going into NVIDIA's earnings tonight has been whether we see an air pocket in demand for NVIDIA's current computing architecture, Hopper, before the launch of Blackwell in the second half of this year. And now we don't see that playing out just based on the fact that demand for AI infrastructure is not going away. It's actually being turbocharged. And we've seen this play out this earnings season, most clearly demonstrated in the CapEx budgets of the hyperscalers. These are NVIDIA's largest customers, and we're now expecting CapEx budgets here to increase 35% this year. A large portion of this is going to be directed towards NVIDIA. And the news story last night that AWS is halting orders of the Grace Hopper superchip has really reignited these air pocket concerns. But it's important to note here that this is just for the Grace Hopper superchip, and lead times are around 2 quarters, 5 to 7 months. So NVIDIA already has Amazon's orders for the Grace Hopper superchip for Q2 into Q3, and that really serves as the bridge that we need in order to get to Q4 and the ramp of Blackwell. But also, as Blackwell ramps, it's going to be very supply constrained, just as every single product launch in NVIDIA's history has been, just as most product launches across most industries are. So the vast majority of customers are not going to have the luxury of being able to halt Hopper orders if they want to plow on with their AI roadmaps.
Okay, so we've talked to you in the past about the competitive environment, and I know you're pretty confident. You see the competition looking longingly at the kind of situation you describe and saying we want in on that, but you're confident that NVIDIA has what it takes to stay the course. AMD trying to catch up, some of the data center operators themselves trying to catch up with their own chips. Do any of them stand a chance, or if they do, over what time scale?
It's a terrific question, and the custom ASICs markets, which is really the chips that Google and Meta are developing for themselves, these serve for a slightly different use case, and they're really for internal workloads, because if we compare the total processing performance of these chips versus NVIDIA's H100, for instance, the H100 is 10 times better, but these custom ASICs are around 8 times cheaper. So when the highest compute workloads aren't necessitated, it makes infinite sense for these hyperscalers to be using their own silicon. But when it comes to providing GPUs to their cloud customers, really merchant silicon remains the gold standard here, and we don't see that going away. So they're very much better on the cost side, but nowhere near on the performance side.
Is the silicon where the advantage is, or is the software where the advantage is? Because at the moment, NVIDIA's fantastic at tying those two together. You have the kind of the handshaking between the software and the hardware is so good. and that makes it a very compelling product. Others are talking about trying to kind of break that link with the software that would allow, therefore, other chips to be used maybe more efficiently. In terms of how we think about the future valuation of NVIDIA, which one is it based on? And is it based on the assumption that those two continue to be as good as each other? And if there was a crack to appear, would it be in silicon or would it be in software?
So both are important because they work together. But software is actually going to become even more important when we're thinking about training these incredibly large language models. I mean, what Jensen really emphasized on the last earnings call was that accelerated computing, every single component of this requires software. And this is something that has been missed by a lot of people. NVIDIA have obviously been developing CUDA for over a decade and have a lead here. But AMD are making some inroads with their ROCm suite, but it really takes a lot to prize the developers that work within NVIDIA's ecosystem out of this. And innovation with software, but given this installed base of developers, is arguably going to be an even more important piece of NVIDIA's growth story from here on out.
We were just talking to the CEO of SSE, talking about server farms and how much more electricity, electrons, the AI story is going to create. AI stocks are really expensive, super expensive. Energy stocks are quite cheap. How do I play the AI story in a different way? Are there better ways now to get the kind of the pickup that we're going to see as we go through this process from a stock price point of view, rather than just simply going, it's all about NVIDIA?
Absolutely. We see opportunities in energy, in select parts of industrials that are really crucial for this AI build-out. A company that's actually incredibly well positioned, in our opinion, is Constellation Energy, which has the largest nuclear capacity fit for data centers in the US. The advantage of nuclear is a potential speed advantage here because you don't have to connect to the grid. These sites are large, operational, and already have existing infrastructure very well suited to data centers such as water cooling and scale. But really, it's going to this build-out is going to benefit those energy providers and those electrical component companies that have already existing installed bases, because the speed advantage is really, really crucial here. We're talking about if you can connect a data center up to a power source 2 years quicker than a competitor, you probably receive around 100% price premium here. So it's install-based champions are what we're after on the power generation side. In terms of electrical components, companies that no one's really paid any attention to for years are suddenly now in favor. A company like Amphenol, they provide the high-speed interconnects for the data center. They're the market leader here. They've got the best technology. And NVIDIA's Grace Blackwell superchip coming to market. In this, we've got about $100,000 of Amphenol content. This data center portion of that business is going to continue growing, we believe, at the 30% that it started to over the past year. But it's a very underrated AI story, an unsung hero that no one really ever talks about.
I'm sure they'll talk about it now, though, that you've mentioned it. Claire, I'm having a little bit of deja vu here when we're talking about kind of this acceleration, that we're still having this massive adoption here. Isn't this the exact story that we've heard with Microsoft's Asia business in particular? Their growth is still over 30% quarter over quarter, but the stock gets punished when that growth slows down a micro percent, for lack of a better term. I'm curious when that moment comes for NVIDIA. What is the visibility there for someone who maybe doesn't have a 5 or 10 year kind of fund investment horizon, who's actually trading the stock? When does this stock suddenly is no longer, this is the opportunity everybody wants, and is then characterized as, okay, well, now the growth is slowing down, now we need to get out?
So we have a five-year investment horizon, and this accelerated compute build-out, we believe, is a 5 to 7 year sort of time frame. We think that 2027 is going to be sort of the crucial milestone where the first stage of this AI infrastructure build-out really sort of comes to fruition, where we're going to see AI deployment achieved at scale for the first time. And that's where we'll see the majority of data centers really switch to accelerated computing. We've got to see about 100,000 data centers re-architectured in order to accommodate for accelerated computing. AI server penetration was only 10% last year. It's got to go to 30%. But from then on out, we're going to see a PC refresh cycle. We're going to see a smartphone refresh cycle. I've lost count of the number of AI PCs that have been launched just this week.
Yeah.
But it's this continuation of this AI infrastructure build-out, which starts in the data center, it then moves to the edge. We then see enterprises adopt, and the next wave of growth from 2028 will be automotive for NVIDIA. So as long as we don't see sort of these waves dovetailing in sort of dramatic fashion, we don't think that there's a lack of a growth engine for the company anytime soon. I mean, getting in on a shorter term horizon, there's obviously going to be volatility around the stock price. Expectations move up and down. We tend to invest in NVIDIA when sentiment is low, and trim it when sentiment is too high.
Okay, thanks so much. Thanks for joining us, Claire. Really good to speak to you. You got me looking up the Amphenol share price here. It's made gains over the last few years, maybe not as much as NVIDIA, but thanks very much for joining us. Really good to get that wide-ranging conversation around the NVIDIA story. Claire Playdell-Bouverie, Fund Manager at Lion Trust. More ahead. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
47 minutes into the equity market session. Good morning. Equity markets here in Europe drifting a little south, but not by much. A little bit of volatility, but we are all waiting for the Nvidia numbers a little bit later on. Some significant stories that we are watching. Marks & Spencer out of the UK. SSE is another stock as well. Keep an eye on what's happening with Schneider Electric, backing away from the Bentley acquisition. The action, you could argue, though, is in the bond market this morning, certainly here in the UK, where we are seeing front-end two-year gilts rising by 10.5 basis points. The reason for that, UK inflation has cooled, but did so at a rate that was less than expected. We've come in with a higher number and certainly a sticky number when it comes to the service side of the economy. Lingering price pressures at restaurants and pubs, maybe caused, you could argue, by what we've seen with the minimum wage. The data, maybe you could argue, certainly judging by market pricing this morning, will threaten to delay the Bank of England cutting rates maybe as early as June. Lizzie Burden joins us now to break all the numbers down. What are the key things we need to take away from these figures?
Well, you were right to hone in on that services number. It's barely budged from March, but the headline and core numbers disappointing as well. Higher than economists had expected, even though inflation is moving in the right direction. The market reaction, as you say, significant here. Gilt yields soaring, the pound higher. It's actually at its strongest in 2 months. And for traders, a June cut basically off the table now. So 12% is the chance they see of a June cut. That's down from a coin toss yesterday. August is now 40% chance in traders' eyes. That's down from 90% on Tuesday. The only fully priced cut at this point is November. Now, contrast that market reaction with the political reaction. We've heard from the Prime Minister, Rishi Sunak, saying today marks a major moment for the economy. Inflation's back to normal. This is proof that the plan is working. So totally different there. The Chancellor, Jeremy Hunt, was already saying that rate cuts would be a feel-good factor for voters. You can imagine the political pressure on the Bank of England to cut rates now when we're in an election year.
Yes, and we are in an election year. You know, probably has to be by some date in January, but, you know, that's unlikely. So probably an election year. I mean, what does this mean politically then, Lizzie? Because you mentioned what the Prime Minister has said this morning, that this is back to normal, but we heard from the Labour Party opposition, of course, performing the duty of an opposition and disagreeing and saying, actually, this isn't normal. It doesn't feel like normal with prices as high as they are.
Indeed. And while the Chancellor and the Prime Minister have been very triumphant about this, Torsten Bell as well at the Resolution Foundation, not so much so. Look, Rishi Sunak made it his top priority last year to halve inflation by the end of the year. They did that, and yet the poll gap with Labour only widened. Can they translate this into votes by the election? You've still had real wages falling, so they're at the actually lowest level since the financial crisis, put it that way. Living standards, I should say, falling in this Parliament, as admitted by the Chancellor himself. And at the end of the day, whose job is it to cut inflation? The Bank of England.
All right, Bloomberg's Lizzie Burden there walking us through that crucial UK inflation data that we got, of course, today. The market very much reacting to it on a macro level. Let's take a look at some of the other events we're following today, because from the bond market, we go to the equity market. It is earnings palooza over in the States. TJX, Target, and Analog Devices all due to report earnings throughout the morning in the United States. At about 1:45 p.m. UK time, BOE Deputy Governor Sarah Breeden speaking on financial regulation at an event hosted by the European Commission. 45 minutes later, London time, Chicago Fed President Austin Goolsbee speaking up as well, giving his opening remarks at the Holding Company Symposium, adding to the chorus that we're getting from FOMC members over in the States. At 7 p.m. UK time, the FOMC meeting minutes from the rate decision on May 1st will be hitting the wire. How much kind of discourse do you really see? How much division do you see between all of the members? And finally, it comes right back to the earnings story, the macro and micro event of the week. NVIDIA due to report earnings after markets close in the United States. We will, of course, have full coverage right here on Bloomberg TV and radio. In the meantime, we're also keeping an eye on the latest out of the Middle East. Israel has recalled its ambassadors from Ireland and Norway after both countries, alongside Spain, have announced that they will indeed recognize a Palestinian state. Let's get more from Bloomberg's Horizons Middle East and Africa anchor, Jumana Bersetchi, joining us more. Jumana, walk us through the dynamic here off of this coordinated move between Ireland, Norway, and Spain, and Israel's reaction to it.
Yeah, absolutely. So big news out of the region, and specifically in regards to several of these European countries moving towards recognizing a Palestinian state. It should be said that Ireland, Norway, and Spain have said that they're moving towards it, but the final announcement, the formal announcement, is not going to take place until May the 28th. The Norwegian Prime Minister is saying that there can be no peace in the Middle East unless there is a recognition of the Palestinian state. And many people are saying that this is quite symbolic. You will recall that back in the early 90s, it was in Norway. It was the Oslo Peace Accords that was the first time that you got the Palestinians represented by the PLO on one side, Israel on the other, actually engage in discussions and talk about a potential pathway towards peace. None of those accords were implemented, of course, but still significant today that the Norwegian Prime Minister has said that they're moving towards recognizing the Palestinian state as a sovereign state. But the reaction from Israel was pretty swift. They did not like what was announced this morning. They have recalled their ambassadors to both Ireland and Norway, threatening to recall Spain's ambassador. The Israeli foreign minister saying that Ireland and Norway are sending a message to the whole world that terrorism pays. And that this recognition would impede its efforts to bring some of the hostages back.
Jemana, they are not the first. 140 countries, around 140 countries around the world already recognize Palestine. Some of them are in Europe. This is obviously a significant step with some larger countries making this move. Are we expecting other countries in Europe? Is there any indication that other countries in Europe will follow suit?
Guy, that is a very good question. 143 out of 193 member states of the UN per the latest numbers. And I think there is an inclination from other smaller countries in Europe. I know the likes of Malta, Slovenia are some of the countries who've also suggested that they too may be moving towards recognizing a Palestinian state formally. But of course, the backdrop to all of this is very thorny. There is still a war going on in Gaza, plenty of discussions about the potential assault and further ground attack into Rafah. And you've got to wonder whether this is the right timing to be recognizing Palestine as a state in the context of a war that's still raging and the fact that hostages are still held within the Gaza Strip. So it is a very sensitive topic, as you'd imagine, for Israel. And also, I just want to point out, U.S. is not one of the countries that has recognized the Palestinian state as a sovereign state. So something to watch out for will be the U.S. response later.
Jemana, thank you very much. Bloomberg Horizon's Middle East and Africa anchor Jemana Besetcha joining us with the latest on that Middle East, those Middle East geopolitical developments. Let's have a think about some of the other things coming up in programming later today. Other events we're focused on. And Chrissy, you were taking us through the daybook. Of course, it's the deadline for Anglo-American, well, for BHP to come after Anglo-American another time if it wants to. It's already made 2 offers. Both of those have been rejected, partly due to price and partly due to complexity.
Speaking of that complexity, educate me here. What is the process? The 5 p.m. deadline, right? But how does this work from a regulatory standpoint?
If you don't put an offer in, you don't get to make another offer for another 6 months.
It's called a put up or shut up deadline.
Yeah. So there's no kind of active hostile takeover. There's restrictions.
I think they've already indicated they won't go hostile. So I think that's probably they've taken that off the table. But it basically means that if they don't make an offer today, they are restricted from doing so for the next 6 months, which presumably could be something that would open the door to others. So we haven't had, at the moment, they're bidding against themselves, BHP. So if they don't put another offer in today, if they don't confirm the offer today, then others presumably can come in over the next 6 months and make offers. So it puts them in a difficult position.
And it's worth saying it's being watched because of the symbolism here about 2 things. One, copper and the role of copper in the new economy and all of that as a transition for the energy transition. It's such a big story, and it comes at a time where we've seen new records on copper prices. But it's also heralding a new wave of M&A if it comes, if we get another offer, if it's accepted. And we haven't seen big M&A deals for a decade or so within this space. So I think that's why it's taken on such significance, both here in the UK and for the wider basic resources sector.
I'm curious what kind of pushback it gets, though, on that regulatory front. We're talking about it in just the deal flow, but let's say this deal comes to fruition. Let's say there is some sort of premium that is locked in. Who pushes back against it at a point, to your point, that we're already seeing these kind of contract issues at the LME, over in the Shanghai Exchange as well? This could get tricky.
There was some Chinese news this morning that the Chinese were dialing back their buying at this point because of the pricing. So you know,
there has been,
that could be an area.
But there's been this gap between the physical market and the financial market in copper for a while now, which just seems to have grown. Maybe it starts to come in. Anyway, we're done for the day. There's some really big events coming up throughout the day. Nvidia, what's happening at BHP. The Pulse is going to continue the conversation as we work our way towards these critical events. Big move in the bond market this morning, certainly here in the UK. Keep an eye on the effects of that around the world as well. Anyway, enjoy the rest of the day. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Traders brace for results from NVIDIA, the chip maker at the heart of the AI boom, reports later today. UK inflation cools less than expected last month, threatening to delay interest rate cuts from the Bank of England, and Israel recalls its ambassadors to Ireland and Norway after both countries with Spain said they would recognize a Palestinian state. So there is a lot going on today, both on geopolitical fronts, on the data front, and of course on markets. So this is what the European markets map is telling us. If you look at European stocks, they're falling after the latest price data from the UK seems to cast a doubt on hopes that price pressures have been vanquished. Now, again, we have seen this read across actually from what's been happening to the US to the UK, so it's not a given that we'll see the kind of same inflation dynamics, but it's very clear that after that data in the UK showed that inflation slowed less than expected last month, it's really raising questions about not only the Bank of England, but what it means for the rest of the world. I'm looking at US equity futures pretty much unchanged. Again, traders have also grown doubtful of the Fed delivering the 2 rate reductions that were priced in just last week, and then a couple of other things we're looking out for. Of course, there's volatility, there's copper also below, actually above 10,600, and then gold 2,417. Now, Wall Street is betting on blowout quarterly earnings from the AI leader NVIDIA later today. The stock closed at a record high yesterday as investors look for evidence that the chip maker can actually maintain its explosive growth. Now, for more on this, let's bring in Matt Bloxham from Bloomberg Intelligence. Matt, I kind of have to often take a double take because this is one single stock and it's kind of, boosting the whole market as a whole. What are you expecting from NVIDIA?
Yeah, so the focus is really on the revenue print and what they say about the forward guidance on revenue. If you think about it, that's like spectacular growth. The quarter last year, Q1, $7 billion of revenue. The same quarter this year, they guided to $24 billion, and the market's looking for a bit better than that, kind of closer to $25 billion. And then the expectation that that growth continues into next quarter. So the real focus number is going to be what they say about their Q2 The market's looking for just shy of $27 billion of revenue, so that would be about 100% growth year on year. So I think that's where people are really focused, and then beyond that, it's the commentary around what the demand pipeline is looking for. Most of their demand right now comes from a handful of hyperscalers, Google, Microsoft, Amazon, those kind of people, but they're looking to expand their business into the realm of enterprise and government, and they need to kind of continue to sell a convincing story about that demand coming through so that this kind of rapid growth we've seen can be sustained into the future and justify this kind of $2-point-something trillion valuation they have.
I mean, it's just crazy. The numbers around this are absolutely crazy because they must also have much more competition and rivals trying to take advantage of that.
Yeah, the competition's emerging. So their big customers right now, these hyperscalers, are all developing their own chips, which they'll sell alongside the NVIDIA. So the NVIDIA demand won't go away from them, but they'll be complementing it, and it will give them a bit more kind of buyer power against them in terms of pricing. And then you've got the likes of AMD that are also developing technology in this area too. So yeah, I think right now they're still in a very good position from a competition perspective, but if you roll forward 12 months or so, that picture could look quite different. But NVIDIA itself is trying to get into kind of a broader realm of offerings. There's potential talk about them developing CPUs as well as the GPUs, so GPUs, graphics processing units, which is their kind of territory. And if they do CPU too, it takes them into the realm of someone like Intel, and that could really change the whole kind of PC and technology landscape. So that's something for the future.
But Matt, what can they really tell us? So Matt is usually our AI expert. Today you're like our market expert because every corner of the market is looking at NVIDIA. So what can they really tell us about the outlook?
Really, that insatiable appetite for AI product and technology is continuing, and I say it's this extension into enterprise and to government customers, and that actually, every company is looking at AI, and it's did they kind of back that up with big investments in their own technology, not just rely on offerings from AWS and ChatGPT and the like, and develop their own technology. That's kind of where the demand needs to come from.
Okay, Matt, thank you so much as ever for a great breakdown of what we can expect from NVIDIA. That was Matt Bloxham from Bloomberg Intelligence. Also, our columnist, John Authers, put out a great story out today. Actually, his column is entitled, "As NVIDIA Goes, So Do U.S. Stocks," but he argues that it's really not healthy having a single stock to have so much of a hold on all of the market. Now, joining us to discuss, data, inflation, and the path ahead, Freya Beamish, Chief Economist at Global Data, TS Lombard, and also with us, Fabrizio Pagani, partner at Vitale & Co. He's also former senior economic advisor to the Italian Prime Minister and former chief of staff of the Minister of Finance. So thank you, Fabrizio, for joining me in the studio.
Thank you.
Freya, welcome back to, of course, the Pulse. When you look at the inflation figures in the UK, and I know, Freya, you were looking at some of the modeling of what it means, for example, for U.S. growth going forward, but is there a danger that we have a similar pattern of inflation not really being quite there yet?
Yeah, I think before we kind of dive into the details, it does pay to just take a little step back and recognize that inflation peaked at above 10%, and it's now within 0.3 percentage points of the target. So that's a little bit of a moment to kind of, just take a little bit of a breather. I realize it did come in a little bit above expectations. But when we're looking at the leading indicators on services in the UK, we do see potential for continued disinflation there. And when we look at the bigger picture leading indicators, when we look at, for instance, monetary growth or monetary contraction, actually, which is what we've seen at the moment, that suggests that we could even see sort of an undershoot in inflation. So I think today's news is not what we're looking for over the longer picture.
Yeah, but when you say, let's take a little bit of a breather, I mean, this has been in the pattern over the 7-8 months, actually, that markets are desperately looking for that cut and often are not really listening to what central banks are saying. So again, does this change your narrative, or is it just a lot more caution like we heard Governor Bailey say in the past?
Yeah, I think central bankers are very, very cautious because they've done all this research that suggests that there are two inflation regimes. There's non-linearity in inflation. Inflation is either high and volatile or it's low and stable, and nobody knows where the threshold is that kind of flips between those two regimes. But the other piece of research which has been received less attention that was put out actually by the BIS last year in that context, is that monetary growth is also much more highly correlated with inflation in those high inflation regimes. And so if you've got negative monetary growth and your worry is that you're in a higher inflation regime, then you also must expect that inflation should be coming down as well, because money is correlated with inflation in a high inflation regime. So I think the likelihood is that the Bank of England has already shocked the system back into the lower inflation regime, which is not to say that they can kind of sit back and take things easy, because underlying those kind of big monetary shifts is a genuine imbalance in the labour market, which is nowhere more severe than in the United Kingdom. And that's the sort of the longer term problem that the Bank of England faces. But I think to sort of
Freya,
bring this back to what it... Yeah, sure, go ahead.
No, but staying with the UK 1 second, and then I want to get Fabrizio in also to talk about global inflationary pressures. But for the UK, we have an election, and so does it make it very narrow, the window of opportunity for the BOE to actually act?
Yeah, there's elections all over the place, so policymakers have to be a little bit careful. I think in reality, what happens is in the actual moment when the election is called, then policymakers are perhaps a little bit reticent to make big moves. But in the year of an election and kind of around an election, they make the moves that they think are necessary to make. But this does speak to a wider question of politics and the political shifts underlying the reaction function of the Bank of England and more broadly, because there is a labour market imbalance, and that's a political question of whether wage growth is allowed to stay higher in order to solve that imbalance, or whether the Bank of England should keep rates higher for longer to try to bring demand back down to wherever it considers to be supply. And that does become a political question, which that could undermine some of the central bank's independence if they continue to tread the path of trying to keep rates higher.
And Freya,
for longer.
let's listen. Yeah, let's listen to Governor Bailey, who was speaking last night about the next move being a cut.
As we've set out, I think that the next move will be a cut, as I've said. The question for us is how long we have to maintain this level of restriction.
That was, of course, Governor Bailey of the Bank of England. Fabrizio, it's a much clearer picture, actually, with the ECB saying that they will probably cut in June. Is that because they've communicated more effectively? I mean, it's pretty incredible to say that when you look at the Eurozone, it's easier to set monetary policy there than it is in the US or the UK.
Yes, I think, first of all, data are different. Not only inflation data, because inflation went down more rapidly in the EU than in other economies. And second, obviously, the status of the economy in the European Union is much different from the one of the US. So, for example, also from an empirical point of view, you talk to managers and entrepreneurs, they don't raise inflation issues anymore, but they raise issues about growth. So there is a growth concern. Of course, the mandate of the ECB is price stability, but the economic outlook, of course, is very much part of that. And a testament of the independence of the ECB is, by the way, the fact that there is no really correlation and not even any political discourse about the European elections, which will come in June, and the decision which the ECB will take in June.
But will that, again, does that make a real difference to what you're seeing on the ground in terms of growth, in terms of lending? Freya also made a wonderful point about wage growth and where that needs to be after the cost of living crisis that we've made.
There has been an erosion of the purchasing powers, particularly of the less wealthy families, and this is something which politicians and finance ministers have to take into account. I would say that the economy has also, there are major differences between the northern countries, in particular Germany, and southern countries, in which, it's a bit reverse. We see in Mediterranean countries growing more than the Nordic one.
And Freya, when you look at Europe, and I want to go back to some of your great analysis looking at soft landing in the US and overcooked, but does Europe, again, we're underestimating maybe some of the policies that can be put in place post EU elections, June 6. Does that make a material difference to then your potential outlook for European growth?
I think European growth, once the ECB gets out of the way, I'm actually quite positive on European growth. I think there are big structural issues, which Fabrizio was sort of alluding to there, with what's considered to be the core of Europe. Germany is supposed to be the locomotive, but it's very exposed to the shift in Chinese exports, the shift towards the greening of the Chinese economy, and the vast amounts of money that are being thrown at that sector, because Germany is a sort of an auto-centric economy. I think looking at growth more broadly, though, and looking to the sort of what's considered to be the periphery, I'm actually quite positive that once the ECB gets out of the way, that savings rates can come down. Savings rates look extremely high compared with where wealth ratios are at in terms of how much people need to save. You can argue precautionary savings should be a bit higher, but even so, it looks like there should be some tailwind there for the savings rate to come down. And I think also when you start to see real incomes recover, remember the European cycle is lagging the US cycle. And what we saw in the US was that once real income started to recover, productivity growth started to recover as well. And you get this kind of virtuous cycle kicking in. And the ECB, once it's gotten out of the way, and similarly with the Bank of England, once it's gotten out of the way, that virtuous cycle can actually start to kick in. And the worries that they've had over the structural deterioration, the supply side deterioration, productivity deterioration, are actually because demand is depressed, and not because of a very intense and long-lasting deterioration of productivity growth.
Freya, thanks so much. We'll be back with Freya and Fabrizio. Staying with us, of course, for more market insight, Fabrizio Pagani, partner at Vitale & Co, and Freya Beamish, chief economist at Global Data TS Lombard. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Welcome back to The Pulse, everyone. Now still with us, Freya Beamish, chief economist at Global Data TS Lombard. Also with us, Fabrizio Pagani, partner at Vitale & Co, former senior economic advisor to the Italian PM. Freya, you have a note out, which is really well written, concise, and to the point about Nixon shocks. And basically, you argue in this that the U.S. and Chinese growth models cannot continue to coexist as they are. Are you expecting a change in the system, or is one country the winner?
I think I'm expecting a change in the system. I guess it depends how you define winner. I would bet on kind of US US stocks over Chinese stocks, but I would bet on I would put my money into Chinese bonds before I would put my money into US bonds, depending on the hedging ratios. And I'm talking kind of longer term here. And that's because I think the US is shifting to a more sort of high pressure economy that'll be conducive to higher growth as well as higher inflation and capable of sustaining higher interest rates. Whereas I think that China is making, to cut a long story short, a lot of the same mistakes that were made by Japan. The schism comes in the realization that China is much bigger than Japan when Japan was making these mistakes in the mid-90s. So it's fundamentally impossible to get the Chinese current account surplus up without kind of deteriorating the U.S. current account deficit, and that's politically a major schism that the international monetary system is going to have to face. So the likelihood of some kind of an FX shock over the next next 12 months is quite high, given the likelihood that China will need to reduce its currency, depreciate its currency, and who's coming into the White House.
And I was going to ask you, I mean, does the FX shock, is it regardless, or is it much more exacerbated if Donald Trump is in the White House and, goes much harder on China than we're seeing now?
I think the dollar's place in the global system is being undermined regardless of who's in the White House. I think the likelihood of an outright shock is greater if Trump comes in the sense that he is going to tariff China, and he is then going to respond to tariffing China by saying that China is manipulating its currency, which is not exactly fair, but that's probably how he's going to respond, and that's going to remind him that he wants a weaker dollar, and so do all of his advisors. So the likelihood of a shock from that side is quite intense as well. But even without Trump, the exorbitant privilege where the dollar is strong, both in terms of when the US is strong, but also when there's a global recession, is becoming seen as an exorbitant burden. So there's this move towards average inflation targeting, there's a move towards pro-cyclical fiscal policy, and all of these things gradually undermine the dollar, not to mention the search by EMs for a non-dollar alternative, which at the margin diverts funds towards the renminbi.
Fran, many questions also for Europe. And you hear in the corridors of power in all major European cities trying to figure out, well, if Trump comes in the White House, is there any way of proofing your economy? Fabrizio.
But this will be a major geopolitical challenge for Europe from every point of view, economically, trade, investment, and of course defense. What we do with NATO, and what it will depend also what, of course, Trump will finally decide to do. But more generally, I think Europe is a bit at a crossroad, and the next Commission, the next legislation will test, the solidity of Europe in a world which is rapidly changing. So we need to define this strategic autonomy of which Macron speaks a lot. But we need really also a conceptual framework to define it, to interpret it. It will involve trade, investment, raw materials, but also internally.
Is there a commonality of people wanting to do that, or is it each party for their own?
No, I think there is a political discourse which is taking shape, in which France is pushing a lot, I would say, and in which Germany is probably more conservative in the sense that the pace of the change doesn't need to be as fast as France is proposing. But this will be really a matter for the next Commission. And you have interesting elements of that in the two reports of the Italian former Prime Minister, Letta and Draghi.
Thank you so much, Fabrizio. We need to get you back on to look a little deeper at some of these, of course, reforms put in place, or at least some of the competitiveness questions over Europe. Fabrizio Pagani, partner at Vital & Co, and Freya Beamish, chief economist at Global Data TS Lombard. Coming up, we talk BHP and its bid for Anglo. This is Bloomberg.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Now, BHP has just hours to launch a blockbuster bid to buy smaller mining rival Anglo American or put its audacious takeover plan on the shelf. Let's get more with Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, this is crunch time. I mean, they either do it now or they don't.
That's right. We have a deadline at 5 o'clock this evening, London time, by which time Anglo American has to make a formal bid or walk away for 6 months. The other thing that could happen is Anglo American could ask the takeover panel for more time to consider the bid, but we've got no sign that's going to happen at the moment. So we don't expect BHP to make a hostile formal offer without some engagement. So we're waiting to see whether BHP offers a last-minute sweetener to force Anglo to the table, or whether Anglo shareholders force Anglo to engage with the conversation. So we'll know by the end of today.
I know, it's really exciting. So, Will, why will they not go hostile? And are we going to see other bidders come in?
I think they won't go hostile because that kind of bid doesn't work in this industry, and it will prevent them doing the due diligence that they need on the company. At this stage, there are only two other companies that could come in, Rio Tinto and possibly Glencore. I don't think anyone in the market expects it at this juncture. But Anglo American is going to change, and the mining industry will be reshaped over the coming years, for sure.
Thank you so much, Will, and everyone at our desk, 5 p.m. today. Will Kennedy on commodities.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Traders brace for results from NVIDIA, the chip maker at the heart of the AI boom, reports later today. UK inflation cools less than expected last month, threatening to delay interest rate cuts from the Bank of England. And Israel recalls its ambassadors to Ireland and Norway after both countries, along with Spain, said they would recognize a Palestinian state. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now let's get more on one of our top stories. Israel has recalled its ambassadors from Ireland and Norway after both countries, along with Spain, announced that they will recognize a Palestinian state. Now let's get more from Bloomberg Horizon's Middle East and Africa anchor, Jumana Bersace. Jumana, talk to us a little bit about what exactly we're expecting. It feels very significant because around the world, about 140 countries recognize, of course, a Palestinian state, but very few in Europe do.
Correct, Fran, and that is exactly the context. So this morning, we found out that Ireland, Norway, and Spain will be moving towards recognizing the Palestinian state, though the formal ratification is not set to take place until May the 28th. Significant even within Europe, because we know that the Spanish Prime Minister Pedro Sanchez, for the last couple of months, has been lobbying to get more EU member states on board. And up until now, Sweden is the only European EU country that has formally ratified the Palestinian state. The Norwegian Prime Minister is saying that there could be no peace in the Middle East unless there is a recognition of a Palestinian state. Very symbolic coming from Norway. You will recall that in the early 90s, it was Norway that hosted those Oslo Accords, which were the first attempt at putting together a pathway towards peace between Israel and Palestinian representatives, the PLO at the time. But the reaction from Israel has been quite swift. They have now recalled their ambassadors to both Norway and Ireland, and they have threatened to recall the ambassador to Spain. The foreign minister has said that Ireland and Norway are sending a message to the world that terrorism pays, and that the recognition would indeed impede efforts to rescue the hostages that are still in Gaza.
Jumana, what can you tell us about the offensive on the ground in Rafah? So it seems that the U.S. has softened its earlier resistance to a broader military operation by Israel in Rafah.
Yeah, so this is a Bloomberg story that we put out overnight, Francine, and it is in the back of the U.S. National Security Advisor. Jake Sullivan did a trip to the region. He met with Arab leaders over the weekend. He met with several Israeli officials, including the defense minister on Monday. And on the back of those meetings, it seems as though U.S. have started to soften their stance, their resistance regarding a potential offensive in Rafah that we've been talking about for the last couple of weeks. And it seems as though some of their major concerns regarding mounting civilian casualties and potential humanitarian situation on the ground have been allayed, namely because so many people have moved out of Rafah. It is estimated that around 900,000 people have fled Rafah in the last few weeks, but it is also estimated that there's still around 400,000 on the ground. So this was reporting from a U.S. official who spoke to Bloomberg and said that some of those U.S. concerns have been allayed. But whether or not Israel are actually going to go for that full-blown offensive is a big question. So far, they've limited it to the borders and the periphery of Rafah as a city.
Thank you so much, of course, for the update, Jumana there, Bloomberg Horizons Middle East and Africa anchor Jumana Bersetche. Now, you can also watch some of the live pictures from Tehran, where huge crowds are gathering ahead of the Iranian president's funeral later today. Now, earlier, the country's supreme leader, Ayatollah Khamenei, led funeral prayers in front of the caskets of the president, the foreign minister, and others who were killed in the helicopter crash on Sunday. Now, onto some corporate news, and China has signaled it's ready to unleash tariffs as high as 25% on imported cars with large engines. That's as trade tensions escalate with the U.S. and the European Union. So let's get the latest from Bloomberg's Ollie Crook. Ollie, tell us, first of all, good morning, but tell us a little bit more about some of these tariffs. I mean, how much does the U.S. actually sell to China?
Yeah, so this is the big story. Obviously, Biden came out with his tariffs from the Chinese cars going over to the U.S., and really the big story there is that, in fact, they don't sell many cars in the United States, right? But now the EU is sort of prepping their tariffs. They're going to release those in 2 weeks, and those are the cars that are coming from China into the European Union, and that is much more significant for China. So what China is saying is now, listen, if you do that, we are going to retaliate. We're going to hit these big engine cars, and a lot of these cars, the big, most highest margin cars that you see in Stuttgart from Mercedes-Benz, the big Maybachs with huge cylinder engines, those are made here and sent over to China. If you put a 25% tariff there, that is going to be meaningful. It's going to have a meaningful impact on their bottom line.
I mean, so Tesla is also, struggling with sales in Europe, but Tesla's big bet was also on China just a couple of months ago.
Yeah, correct. So Tesla has production both in Europe and in China, but actually a third or a fourth of the cars from Tesla that they sell in Europe come from China. So this is another one that's going to be caught in the crosshairs. And we just got this sort of monthly data from Tesla. Their sales are going down. They're actually losing market share here in Europe, particularly when they were used to be the only game in town. They no longer are. So they're sort of losing momentum here in Europe.
I mean, does this quieten down post-U.S. elections? Is it just like a tit for tat? Is it politicking, or are these tariffs left to say?
I mean, you think about it, right? You say there's a big contrast between Trump and Biden. However, on the sort of economic policy and a lot of the sort of tariff policy, it hasn't been that different. It feels kind of America first on some of the industrial and economic policy. I don't think that anyone in the White House that gets in, whether it's Biden, whether it's Trump, is going to go any easier on China. The question is, what is Europe going to do? How far are they going to follow the U.S.'s lead? And that is a question that they need to resolve, particularly since there's some disagreements on that, particularly between France and Germany.
Always. Ollie, thank you so much. Ollie Crook there with the very latest on some of these tariffs on the other side. Now, coming up, we talk elections, we talk EU elections. The far-right party of Marine Le Pen is on track to beat French President Emmanuel Macron's group in the European elections next month. Well, we speak to an MP from her party and discuss what it means for the EU's agenda. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back, everyone. Now, the markets are definitely moving on the back of that UK inflation figures. Let's bring you up to date with what's going on in the markets. Now, European stocks falling, bond yields actually rising. We had the latest price data from the UK, and it's just casting doubts on hopes that price pressures have been vanquished. Now, we spoke to Freya Beamish of TS Lombard. She said, look, we're maybe overreacting a little bit in the markets, but certainly these figures are reinforcing concerns that inflation pressures globally remain sticky. That could prevent central banks from easing policy as soon as currently anticipated. Now, in France, the far-right National Rally Party of Marine Le Pen has said it will end cooperation with the Alternative for Germany party in the next European Parliament. Now, it follows comments by an AfD lawmaker that appeared to play down the crimes of the Nazis. Now, cracks are starting to appear in some of the far-right groups that seemed on course to make major gains at next month's European elections. But the National Rally is still leading President Emmanuel Macron's group in the European polls by a double-digit margin. Such a result could have ramification for some of the EU's biggest priorities, including defense and the climate agenda. So let's discuss all of this with Thibault François. He's a French member of the Parliament for the National Rally. Thank you so much for joining us today. First of all, Monsieur François, how do you think Europe's far-right parties will actually do in elections in Europe 2.5 weeks from now?
Yes, hello, Francine. Thank you for your question. I do think that every nationalist party and sovereignist party in Europe are going to score. You can see that the progress of the Rassemblement National in France, which is now credited of 33% in the polls, is going to score. And we see that it's a sort of wave going all around Europe. We have seen what is happening in Hungary. We have seen now the PVV, which is our ally with Geert Wilders, it is now entering the government. We also see that our ally in Austria is also winning these elections. We see the same in Flanders. So I do think that we can expect on the 9th of June to have waves of sovereignist party entering the European Parliament.
Can you talk to me about why you've broken ties with the AfD in Germany? So why do you think, first of all, they're moving further to the right? Is this to win votes, or is it just the complex of the party? And what does it mean for your alliances in the European Parliament?
It was very clear. We have seen the statement of the head of the list of the Alternative für Deutschland, which is totally unacceptable. He was playing down the role of the Nazi during the Second World War, which is definitely a red line for the Rassemblement National and for any other member of the ID group. So we decide very clearly, and our president of the party, Jordan Bardella, and also Mrs. Le Pen just state that in the next term in the European Parliament, the Rassemblement National and most probably any member of the ID party will not sit in the European Parliament with this party anymore.
So will you join the ECR, the Conservative Nationalist European Conservatives and Reformists?
But every doors are open, so now we clearly stated that we are not going to sit in this group with Alternative für Deutschland. And just for an explanation, the ID group is composed of 11 nationalities. So we are going to ask, and the ID is going to ask, most probably for Alternative für Deutschland not to sit in this group anymore. And we see we have two options. The first one is staying and having a consolidation of the ID group in the next term, because we are still we have the capacity to exist and to remain. And just to recall that the Rassemblement National is very likely to have between 30 and 33 members of the European Parliament, which will make ID group a very big group in the European Parliament. And other options also are the composition of either a very big group in the European Parliament with a fusion of two groups, the Conservatives, as you mentioned, and also the ID group. So every options and every doors are open. We are very pragmatic. We are waiting for the result of the 9th of June. And first of all, we are going to get focused on the national election. We have 20 days to win and to send to the European Parliament as many members of the European Parliament as we can. Yeah. And after the 9th of June, we are going to sit at the table with any other members to discuss about that.
But do you think that actually, I guess, these elections will be crucial for the French presidential elections in 2027? Will Marine Le Pen use this as a springboard?
Yes, these elections are a milestone, I would like to say. We used to call it in France a midterm elections, because these European elections that are going to happen on the 9th of June are really 2.5 years in the middle of the mandate of Emmanuel Macron. And we are clearly calling every single French that is unhappy of the politics of Emmanuel Macron to go and vote for us on the 9th of June. And you have seen that. We are credited of the double of the polls of Emmanuel Macron. So it's really a very clear message that we are sending. And you may know that Jordan Bardella, if we win and if we are the first one to this election, to this European election, is going to call for general elections in France. And we hope that Emmanuel Macron is going to go back to the people and ask the people and call for general elections to have the opinion on the French people. And it's, of course, a step further for Mrs. Le Pen for the next presidential elections. And you might have seen also the polls she's given in two options, winning at the second round of this presidential election. So we are working on that.
So you seem very confident, first of all, that you'll do quite well in the European elections and then maybe in the French presidential elections as well. How much of a reversal, if you're part of this broader, larger far-right bloc in Europe, how much of a reversal will we see in some of the policies put in place today? So, greening the economy, becoming the first climate-neutral continent by 2050, also giving support to Ukraine. How do you see those main issues changing?
We see that we are going to enter with not a majority, but a blockade majority in the minimum. So to have a blockade majority in the European Parliament, you need to have 135 seats. And I can already tell you that even if we don't stay in the same group, the number of members from the Conservative group and from the ID will be able to block some text from the European Parliament. We are also going to be able to raise and draft some motion of censorship to the European Commission. So it's very clear that now the European Commission is not going to work alone. It will have to listen to the voice of the people. And of course, one of the first things we are going to claim is to come back on the Migration Pact, for example.
Yeah, I was going to ask you actually, so are we going to see much harder border policing and drastic cuts also to migration after the bloc just approved this new bill?
Sorry, can you repeat it?
So the question is, how much will you focus on trying to change the green agenda, and how much will you focus on extra border controls?
For the border control, it's very simple. We would like to impose double borders. So one national border, having some controls at the border, is a necessity in France regarding the mass migration and the numbers of illegal migrants entering the European Union. And of course, we want also to have strong external border. I just would like to recall that the number 3 on our list is Fabrice Leggeri. He's a former director of Frontex. And of course, you have seen from the inside, I was working the Frontex policy and agency of the European Union. We see that they were most likely to welcome the migrant and not pushing them back. So we want to get back on that, which is a very important point. And you were asking a question regarding the green agenda of the European Union and the neutral carbon. For example, it's a madness. We have seen the decision of banning some fuel and gas motor for vehicles. It's unacceptable because how do you do? I'm elected in a region in the north of France when you need to have your car, and how do you go to work? You have the necessity. No one in France is able to buy a new electric car, for example. So it will be a major point to defend the French people.
How much do you think Europe should support Ukraine going forward?
We will see what is going to happen. I think one of the major points will be what will happen in the presidential election in the United States. And we also are going to see what is going to... We have a very strong debate in France of the amount of money that is sent to Ukraine, the weapons and so on. And I think we should go back to the people and ask them what they really do want. Our party is, of course, in favor of supporting Ukraine, but we have some question regarding the amount of money which is sent and also the work of the European Union. We are calling for an emergency meeting, for a peace meeting. We don't want to go in a third world war.
Can I also ask you, we're hearing that actually the Commission President, Ursula von der Leyen, is trying to shift a little bit to the right. Do you think in that stance she could get a second term? Would you be in favor for her staying on as Commission President after the elections?
we state already very clearly that we are not going to vote for Ursula von der Leyen. She was, over the course of the last 5 years, and I just want to recall that she was elected by 9 votes by the European Parliament. And I can already tell you that these 9 votes, the French delegation is probably going to get them. And we are not going to vote for Ursula von der Leyen. She was the one pushing a crazy Green Deal agenda of the European Union. She was the one pushing also the Migration Pact. And the French people doesn't want it. And in our alliance, very clearly, every single member of the ID group in the European Parliament says that we are not going to vote for this candidate. She might say that she's going to shift the majority on the right. We don't think she's going to do that, because she was working over the course of the last 5 years with the left, with the Greens, and with the extreme left. So we don't believe any word of what she's saying.
Okay, at least that's crystal clear. Thibault François, thank you for joining us today, the Member of Parliament for the French National Rally. Coming up, we continue talking politics. We also talk corporates. Barclays could be requiring more U.S. staff to be in the office 5 days a week. We have the details next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy, with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back, everyone. Now, UK inflation fallen less than expected, fueling doubts that the BOE can actually start cutting interest rates. Now, consumer price indices rose 2.3% from a year ago in April, down from 3.2% the previous month. Now, BOE and economists had expected it to drop to 2.1%. Now, for more on all of this, we're joined by Ven Ram from Bloomberg's MLive team. So, Ven, when you look at the inflation numbers today, does it delay or does it actually deter BOE cuts?
I think it should provide some pause for thought for the some of the dovish-leaning members on the policy committee, Francine, because April, they had set a lot in store by April. We were supposed to get an inflation reading close to 2%, which is the BOE's projections for the spring were exactly 2%. The markets were expecting 2.1%, and we got a number much higher than even that. And if you look at core inflation and services inflation, both around 4% and 6%, that's kind of pretty much unchanged. So the question then is where is the room for the Bank of England to cut rates? If we are lucky, we could get one rate cut by the end of the year, but certainly the evolution of inflation suggests that the rates should remain higher for longer.
Yeah, but you're a great student, or you watch really a lot of the treasuries and all the market moves. And I wanted to ask you a little bit about gilts, but overall there's been a big move, and I don't know whether traders also look at the Bank of England numbers or inflation numbers and wonder what the Fed can do and whether they can cut as much as priced in.
Absolutely. I mean, this is rippling through all the markets here across the Eurozone, across treasuries, as you mentioned. You know, we started the year with 6 rate cuts factored in for the Fed, and now it looks like, you know, even one or two rate cuts. Markets are thinking whether even 1 or 2 rate cuts are a possibility. If we have heard from Fed speakers this week that, look, that the neutral rate is higher. We have heard Loretta Mast saying that, look, she's not penciling in as many rate cuts as she was planning earlier on. So all that is weighing on treasuries and sentiment on gilts and Eurozone yields, and that's what we are seeing.
Van, what's the next data point, actually, that the BOE and that gilts will be watching for?
I think they're going to look at the labor market, and I think that, you know, the persistence of the labor market in the UK is extremely tight, and unless there is some cooling of that labor market, I don't think the BOE is going to be in a position to cut rates. Obviously, also crucial to the calculus is services inflation. At 6% now, it doesn't give any confidence to the BOE that, you know, the headline inflation is going to crumble anytime soon. There is a very strong correlation between services inflation and headline inflation, and with those services inflation, with that services inflation at 5.9%, it's hard to get inspired about a rate cut anytime soon.
Ven, thank you so much. As always, you can also follow Ven Ram and his colleagues on our wonderful live blog. He is a cross-asset strategist with our Markets Live team. Now, Barclays, amongst Wall Street firms, weighing whether to require more workers to be in the office 5 days a week. Now, it comes as U.S. brokerage regulators enact new rules for supervising work at home. Now, let's bring in our very own Tom Metcalf, Bloomberg's managing editor for finance and investing in the EMEA region. Tom, I looked at the headline and I said, what, people still work from home? I mean, I thought that was like done and dusted from finance world.
Yeah, look, I think when it comes to high finance, so the deal makers, the traders, you know, broadly speaking, at the Wall Street firms, you might think of the JP Morgans, the Barclays. That's actually already happened. So it's interesting. There's obviously a subset of employees here who fall under FINRA, the US regulator, where perhaps there is still that flexibility we associate with the pandemic. And for me, this story is just a great reminder of there is sort of still within finance writ large a big division. You know, if you're at a retail bank, you've got a lot more scope to be working from home, and a lot of banks set their stall out as this is one of the big kind of almost, you know, recruitment attractions of us.
I was going to ask you, does that make a difference actually in talent retention?
I think for the firms that do offer it and can offer it, yes. I think, you know, when you're thinking of the traders, the investment bankers, I'm pretty sure those people are going in for those job interviews expecting to be in 5 days a week, certainly saying they're going to be in 5 days a week. So I think, you know, Wall Street, you know, high finance Wall Street, you know, you tend to see this whole work from home debate is largely parked for sort of, you know, particularly the kind of high flyers, high paid people.
Tom, as always, thank you so much. Tom Metcalf there, who manages our investing and finance team. Up next, Bloomberg Brief with Danny Berger and Manus Cranny in New York. We'll, of course, talk about all of the market action, but we also have quite a lot of corporate news, and then it's NVIDIA Day. If you read one thing, there's a column by John Authers basically arguing that they've just become too powerful because everything hinges on what NVIDIA says later. This is Bloomberg.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Countdown to NVIDIA. Investors await the chip maker's first quarter results after stocks hit yet another all-time high. Plus, retail earnings come from Target. TJX will get more insight on the consumer. And China hints at a 25% tariff on imported cars that could hit U.S. and EU car makers. Good morning, Manus.
Good morning, Danny. We're counting down. We've got 24 records in a row. We've given 1/10% back. Get ready for a $200 billion swing around on NVIDIA. Typically, and we'll talk more about this in just a moment, there's NVIDIA down 1/3% at the moment. But the skew is very much tilted towards a full bullish beat by NVIDIA. We'll talk about that in a moment. For the moment, we're giving back 1/10%. The measures of risk out there, Goldman Sachs say risk appetite is at the highest since 2021. What kind of paradigm are we shifting into? We'll ask Apollo Torsten Slok about his vision of the next paradigm. 10-year yields spiked a little bit higher on the back of the rise in British government bond yields as inflation in the UK came in a little bit higher than the market had anticipated. And that gave us quite an outsized reaction both in the pound and two-year government bond yields. Two-year government bond yields, as you can see, spiking higher at the very short end of the curve. That promise of a return to 2% inflation seems to be delayed. Sterling went bid. The bond market went up as well. Waller came out and talked about reassuring signals in price pressures. But again, it is about an extension of when those rate cuts may come in the United States of America. Sterling's at a 2-month high. Go on, Sterling. Danny, good morning.
We get some Goolsby comments today. We also get some FOMC minutes. But let's be honest, the risk event is NVIDIA. And the risk is this, is that the market is extremely one-sided going into these NVIDIA earnings. For example, Goldman Sachs' risk indicator, it shows the highest amount of risk appetite since 2021. Citi flows reflect that as well. Citi saying that the market is very one-sided. And yes, NVIDIA might come in really good. It might surprise the market as it tends to do, but it just goes to show if it doesn't, there's a big buildup that might be pain once the dam breaks.
Yeah, and if that dam breaks on the downside, by the way, they have raised their forward guidance in over 30% of their earnings call. They've beaten on sales estimate, and they've delivered earnings per share beats 80% of the time. So it's like a triple crown in rugby in terms of their capacity to deliver. Yes. But it could be a clearing event. I mean, that is the other side. You can look at this in a number of different ways. One, it could fill or kill in terms of sentiment, which is a wonderful phrase, but it can also be a clearing event within that Mag 7. But of course, it depends what your view is for AI going forward.
Right, well, the last NVIDIA earnings, the entirety of the S&P moved 2% higher after its earnings. I mean, that's equivalent of a CPI day. You can see why people talk about this as a macro event, but I feel like it's like Pavlov's dog. We hear that NVIDIA is going to earn, and we start to drool and buy up stocks.
We now know where Danny's retirement fund is majority placed.
Oh, man, I can't trade individual stocks. Or else,
I know
we might be talking about something different. Okay, let's bring in SocGen's Coco Akablua onto this conversation, Coco, because, we're not talking about Fed minutes here. We're not talking about speech from a Fed governor. We are talking about an individual company's earnings. But how much today is riding on NVIDIA?
Well, I think it's an interesting situation because corporates, in our opinion, have developed a natural immunity against higher interest rates. And if you add greedflation in terms of their ability to raise prices, they've actually benefited from this environment of high inflation. When it comes to NVIDIA, one of the things that to think about is the S curve when you have a new technology that is being rolled out. So Copilot for Microsoft, for example, is allowing the company to raise prices quite meaningfully, and NVIDIA is obviously in a dominant position when it comes to semiconductor. And our opinion is that you can clearly have a clear-out event because the momentum is so strong. But if you take a step back and you look at the adoption rate of AI and how it's going to transform our daily lives, I think this is clearly the beginning of a pretty powerful cycle as opposed to the end of the beginning. So we are probably more optimistic on the ability of the company to deliver, but more importantly, the pricing power it will have going forward in maintaining margins and profitability.
It's very tempting. We'll talk to Torsten Slok in just a moment, what kind of productivity gain we're going to get, which plays very much to the macro economist view. But Danny and I started the show talking about positioning, sentiment, the skew. You look at Goldman's, you look at Citi, and we get this sense that we are at this very extended bullish scenario. Citi's positioning almost exclusively one-sided. When the tilt in the boat goes so far to the right-hand side, it makes me nervous, but then I'm just naturally nervous about risk. What do those positionings and those skews say to you?
Well, this is an interesting point. Clearly, there's a huge positioning when you have a stock that outperforms so much because investors follow a sort of Darwinian process of natural selection by the P&L of their position. So you have a clear event if you underperform, and then you get the new generation of people chasing performance. But when we look at equity risk premium for the S&P, for example, we don't see the market being as bullish or in an irrational exuberance type scenario, simply because earnings are also growing as fast as the market is going up. And I think this is a very important dynamic because we are having an earnings inflation, so to speak, with companies benefiting from this pricing power, and operating and financial leverage are making earnings reach all-time high as well. So we are not in the camp of seeing this sort of performance of equity markets as a sign of investors' sort of excessive bullishness or excessive risk-taking. And last but not least, we've done some polling from investors, and the number one concern they have is uncertainty about the future. Recession risk.
Coco, if I can just jump in here before we get to that uncertainty about the future point, I want to go back to the pricing power point. I understand the thesis of why AI companies like NVIDIA have pricing power, but when you look at a Target and a Walmart and a tit for tat lowering prices, trying to attract the consumer, you have, for example, Amazon talking about consumers not wanting to pay up as much. Can pricing power continue given the state of the income earning consumer right now?
I think it's important to realize that real wage growth is now positive. So wages are growing higher than nominal inflation or headline inflation. because there's a delayed effect and headline inflation has essentially come down quite meaningfully. The second important point is excess savings. Clearly, they've reached $2.5 trillion at the peak is in 2021, and they have come down by 40–50%. But you still have consumer having jobs. We have a tight labor market. Wages are going up. Clearly, they're not spending as much as they did before, but they are not in a sort of difficult position, which would have been the case had unemployment reached 6, 7, 8%. So I think this is where we're seeing real GDP growth in the US reaccelerating compared to the rest of the world.
Look, there's no doubt about it. This economy is strong. There's a bifurcation in this economy, as Danny says, between working families with food bills and gas bills and upper middle class, which is earning 5% on their CDs. And that's where the challenge of transmission mechanism is for the Fed. We interjected, and we would like to know in terms of the biggest concern. We have a poll, we've got a Morning Consult poll, it's around Biden and Trump and the event risk around the election. What is top of the agenda in terms of concern that could prick this bubble, or this sort of meteoric rise, 24 records in a row in the equity market?
I think the key risk is the bond market. If you remember the Liz Truss mini-budget crisis, where essentially we had a situation where the government was looking to increase budget deficit by doing more fiscal stimulus at a time where inflation was still a problem. And here we have core inflation still being pretty sticky because of service price inflation that are depending on wage growth because of the labor intensity of services. So if we have a Trump scenario in November where we go for more deficits, more government spending at a time where the economy is at full employment, then you could see bond yields surge quite meaningfully, and that could create a massive expansion of the equity risk premium and causing equities to unravel.
Coco, I even just think of where bonds are right now. The more volatility in them, especially when you have central banks like China backing out as holders of this bond market, more individuals are holding it. There are banking regulations which make it harder for banks to absorb losses in this bond market. In an environment like that, where you have this risk of, maybe a Liz Truss moment of more volatility, where do bonds belong in a portfolio? Because so much of asset allocation is based on the idea that bonds are the staid, boring part of your portfolio. And time again, Coco, we're starting to learn that perhaps that's not the case right now.
Absolutely. I think the equity bond correlation is the Achilles heel of multi-asset portfolio. And we're seeing that correlation being itself volatile and unreliable. And this is why there are alternatives like currency hedges or equity volatility and options as a way to diversify away from the dependence on bonds. But that being said, I think it's transitory. So we typically see the equity bond correlation be volatile in a short term, but medium to long term, it still holds, because if the US were to enter into a major slowdown, and we expect cuts to start in March of 2025, the Fed has a put that is essentially reloaded. They have 500 basis points of cutting power to stabilize the economy. But the Achilles heel is clearly on inflation going too high, in which case they don't really have much choice than holding interest rates for higher for longer.
Okay. Coco, thank you so much for being with us, Coco Agobloa. We got through almost an entire section virtually unfettered. It was a thing of beauty. You managed to drag it in. Well done, Coco Agobloa, there, our Society General.
It's a good accomplishment, I think.
I think it's a pretty good accomplishment at 5:10 after a lot of Fed speak. Let's get to the other stories trending on your Bloomberg terminal this morning. This is what we got for you. Citi was fined $79 million by the UK regulators for failures in trading systems and controls. London staffers' fat finger trade caused a flash crash in European stocks. That was in 2022. Citigroup did not dispute the regulator's findings and agreed to settle the claim.
BHP has until noon Eastern today to make an offer for its rival, Anglo American, or walk away. Anglo has already rejected 2 offers from BHP. The last one was of $43 billion. Instead, Anglo unveiled its own plans for a radical restructuring.
Israel has recalled its ambassadors to Ireland and Norway after they announced they would recognize a Palestinian state. The coordinated move, which was soon followed by Spain, underscores how the war in Gaza is focusing the global attention on the issue of statehood for the Palestinians and hurting Israel's relations with other nations.
Now, coming up, the economy is looking strong at least for several more quarters. That's the view, according to Apollo's Torsten Slok. We're going to be catching up with him later this hour.
China signals it's ready to unleash 25% tariff on US and European cars. The details on the latest trade tensions next. Context matters on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is here.
This is a get out the popcorn moment.
An across the board just pummeling of expectations. Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
And lots still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Manish Rennie alongside Danny Berger in New York. We have the latest Bloomberg Morning Consult poll, and it finds that half the swing state voters are worried about violence around the November election. Anne-Marie Hordern is with us. Anne-Marie, we can come back to the main concern about violence, misinformation, and foreign interference. It's there. It's a definite subplot, and I think it's on every newspaper. But as you stand back now, we've had a series of these polls. If you stand back, is there anything demonstrable? Is there a shift? Is Biden making up ground? Is Trump still materially ahead? What would you assess it as?
We do this poll every month, and what you can see in this latest one as compared to last month is that Biden is starting to make a little bit of a shift. One thing is clear, he's performing very well as opposed to some of the Sun Belt states where he did make a little bit of improvement, but he is performing very well in the blue wall, Michigan, Wisconsin, and Pennsylvania. And if you talk to anyone in the Biden camp or any sort of Democratic analyst looking at the election, he has to hold the blue wall in order to win in November. So for the Biden campaign, the fact that he's starting to pick up a little bit of momentum there, that is good. I'm looking at Michigan, it's 46-45, Biden to Trump. Mm-hmm. Wisconsin, 46-47, so very, very tight. And Pennsylvania, 46-48. So he still has some work to do there, but it is so, so close. And I think when you take a step back and you look at where we are now and the months leading up to the election, these 7 swing states are absolutely key. And specifically for the Biden camp, it's that blue wall that is absolutely critical to win in order to beat Donald Trump.
Is there anything that Biden's done differently or anything clear that's helped him advance in some of these blue wall states?
I think what you could see from the Biden campaign is that where Joe Biden is going. I mean, he was just in Atlanta, then he immediately went to Detroit. He is spending a lot of time. He was just talking about AI and chips and Microsoft, which actually when we ask our respondents in the open-ended questions, anything that you've seen in the news about any of these candidates, I looked through some of them and a lot of individuals said, well, he was just in Racine, in Wisconsin, talking about this stuff. So he's spending time and money in these states, and that's obvious. The other thing, of course, that it's happening is the Biden campaign is trying to show a split screen between what the president is doing and where the former president is. And the former president at the moment has been held up in court in a New York trial. And that's the split screen they're trying to show to the American people. And at that same time, we do see some of our open-ended comments for Trump. More than 1,000 of these respondents were talking about that hush money trial.
What's interesting, that imagery, it's almost like a daily sort of media homage. If you look at any other network through the day, it's the pivotal piece in terms of what happened. There are other things going on in the world. We have two different stories. We've got tariffs, again, tariff escalation, potentially by Europe. And then we have student loans, more financing for student loans. Biden widens the student loan relief. What are the details? So what's the top line on that, Anne-Marie?
So what we've seen over the course of the past few years with this administration is they've wanted to do more to shore up definitely the youth vote and also to try to relieve some of that student loan debt. The Education Department has unveiled regulatory changes incrementally over the months. Today, the White House is coming out saying that more than 1 in 10 Americans with federal student loans have been approved for some additional debt relief. There's going to be a lot of criticism on the Biden administration from the other side of the aisle, saying that this is a levy they are pulling before the election to try to shore up that youth vote. And they're doing it once again. When you look at our polling and you ask who is actually better when it comes to student debt relief, actually sometimes it's mixed, because if you're on the Republican side and don't want to see that, they say that Trump will be better for that. But overall, this is something that is top of mind of that youth vote, which we know that Biden is trying to shore up and make sure they go out to the polls.
Anne-Marie, just quickly here, because we also need to cover the tariff portions of this, too. This potential threat of 25% car tariffs from China on the EU and the U.S. Presumably, this is just a Mercedes BMW story. Who does this actually hurt if this does come to fruition?
Exactly. I think this hurts the Germans, the German automakers, the most. And it's interesting because we heard from the German chairman, the BMW chairman recently, who talked about the fact that we don't want to shoot ourselves in the foot as the EU is undergoing this process of whether or not they're going to have higher tariffs when it comes to Chinese EV imports into the European Union. But that's, of course, what they're saying publicly. Why? Because they have a massive stake in getting into China. But I think what this shows is the direction of travel between Beijing, Washington, or maybe Beijing, Brussels, which is there's going to be a tit for tat.
Okay, Anne-Marie, thank you so much. Anne-Marie Horder, they're covering a lot happening in politics. Okay, Manis, we have some breaking news we need to go over. Oaktree says it has taken ownership of Inter Milan, the football club. Manis, to be clear, this isn't a takeover. They didn't buy Inter Milan. It is because the owner, Sunnings Holding, has defaulted on their debt, or rather they haven't paid their debt, and Oaktree, rather than giving them a new loan, a short-term loan, something like that, they have instead decided to take the keys. This is really remarkable when a lender decides to do that, especially for something as complicated as a football club.
I mean, these trophy assets, everything that we've talked about typically is, a bidding war between the Middle East, the Qataris and John Ratcliffe for Manchester United. But here we are, this is an Italian asset. And as you say, it is all about the credit that had already been extended to Inter Milan.
Yeah. And again, this is typically something rare that is done in private credit. They're creditors. They're not in the business of ownership. So significant that Oaktree have decided to take the keys. Okay, coming up, we'll get you your top stories.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's get you your front pages, some look at what's happening around the world. So first up, Manish, I've got the New York Times. From the Donald Trump hush money trial, Donald Trump has declined to take the stand. Usually defendants don't take the stand, but this just now moves us quicker to next week where we're going to get the closing arguments in this case, Manish.
Indeed. Next up, this is what we got for you. We have the Financial Times. Inflation. We started the show with this, a little bit hotter than we expected, 2.3%. The data shifts the expectations of when the Bank of England is going to be able to deliver. Bailey's sort of rhetoric has been undercut in many ways about the timing. I mean, by the way, their inflation is a lot closer to target, let's say, than the Fed's is. But it popped gilts, which popped bonds, which popped sterling. A lot of pops.
Yep, a lot of pops. Repercussions felt ahead of NVIDIA Day nonetheless.
Indeed.
Finally, on Bloomberg, this is the most read story today, Manish, that Barclays is telling staff in the U.S. specifically, get ready for 5 days in the office, specifically those dictated by FINRA rules, because FINRA has new rules for people working at home. And Barclays has said, the cost and change isn't enough to make us let you stay at home.
Yeah, and it's about listing those home destinations. A lot of people are set up with the Bloomberg terminal on the desk, trading from home, or indeed delivering brokerage from home. A year ago, 20%, I mean, there was a couple of polls done, 20% were still happy to work from home. But we did a Harris poll a month ago, and I love this from the head of the poll. Our Peter Pan relationship with remote working is coming to an end. John Gerzema, chief executive of Harris Poll. Peter Pan's died.
I think it's just an excuse, man. If Barclays wants to lay off staff, what a better way to do it than tell people to come in.
Office. Well, JP Morgan brought a lot of their managing directors back last year. Look, we're going to talk to Torsten Slot from Apollo. We're going to see what paradigm shift he sees in the market.
Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our global headquarters in New York, I'm Danny Berger with Manus Cranny. Let's set your agenda.
Countdown to NVIDIA. Investors await the chipmaker's first quarter results after stocks hit yet another record high. Plus, retail earnings hit the tape from Target and TJX for more insight to the consumer. And China hints at a 25% tariff on imported cars. Could the majority hit the US and EU car makers? Danny, good morning. Counting down to NVIDIA.
That's right. It is NVIDIA Day. Stocks a little bit weaker this morning, down about 0.1% after hitting a new record yesterday. The records keep coming and coming, but the risk event is NVIDIA. As we were talking about, Manus City calling it a one-sided market heading into this results. U.S. 10-year yields, those pop higher. Let's call it 3 basis points. We're at 4.43% this morning after UK inflation came in hotter than expected, 2.3%. The expectation was 2.1%. That's also backed us off of pricing for cuts by the BOE. We're pricing now less than 50 basis points of cuts. So there you get a rally in sterling. It was at a 2-month high, slightly backed off this level. Your cable is at 127. But Manus, going back to this idea of NVIDIA, we're talking to Coco Agablua of SocGen earlier this morning, who basically said, look, it's all's okay in the equity market. For one, these AI names have pricing power, and for two, earnings are keeping up with the exuberance.
Yeah, and he talks about the S-curve. He talks about the ability of the likes of Microsoft to ask us for more money, to ask corporations for more money. And when it comes to the debate about positioning, we've got Goldman Sachs and we have a number of other houses talking about Citi, talking about excessively bullish positioning. But he was not of that opinion. As far as he was concerned, pricing power gives you profit power, and it was in syncopation.
Yes, exactly. And that's his reason. Do not worry about where we are. But at the same time, Manus, I mean, valuations are high, but then I go back to the idea, if you were worried about valuations, probably for the past decade, you would have missed out on a large part of this rally. So there you go. NVIDIA today, I still think, like I said earlier, it's the Pavlovian dog. We hear they have earnings, we start to drool, and we start to buy.
Yeah, well, we can get ready for an average move of 7 to 8% on that stock, which is the equivalent of $200 billion, but we'll be counting down to that on sentiment. Strangely enough, there was another facet to consider. It was the latest FOMC minutes. They will be later today, and in terms of what Fed officials have got to say. But let's take a listen to the Nobel laureate Paul Krugman, because he had a thing or two to say about where we were with rates.
On interest rates, I am fanatically confused. I mean, I actually think that you can make a really strong case either way. That we went through a long period of extremely low interest rates, which we thought were grounded in fundamentals, especially demography. And then now we've been going through a period of much higher interest rates with the economy remarkably robust in the face of those rates.
Let's see what Torsten Slok has got to say, Chief Economist over at Apollo. He is our guest this morning, joining us now. So, Krugman, on interest rates, he's fantastically confused. You're not. You're going still for no rate cuts this year. Torsten, good to see you this morning. But I want to get a sense from you. You talk about fiscal headwinds. The middle class savings have popped. I mean, it's almost Churchillian. You know, you've never had it so good. So are we in such a halcyon moment in this economy? Are we moving towards a paradigm shift?
Well, this is a really important discussion, and I think what Krugman exactly is highlighting is the following, that we used to, for several years, basically 10 years since 2013, when Larry Summers first gave his speech, talk about secular stagnation. And the debate was that demographics are significant headwinds. As a result of that, interest rates will quote unquote be low forever. But now instead, we have some other forces that are pushing in the other direction, and that list of other forces is just relatively long compared to the secular stagnation argument. And those things are, of course, that we have deglobalization is inflationary, energy transition is inflationary, the more defense spending is inflationary, and you also have that some restrictions on immigration could potentially also be inflationary. And if you add the final two cyclical factors that are supporting inflation, namely easy financial conditions because of the Fed pivot in November, and because of tailwinds from fiscal policy, if you put all that up on the scale, you have that, yes, still we have these structural forces of secular stagnation in the background. There's just some new forces, namely deglobalization, energy transition, and also in particular defense spending, and even restriction of immigration. Those things are new that are beginning to put some upward pressure on inflation. That's why the debate is around how much weight should we give to these two different lists of arguments.
And Torsten, you add that, which you so brilliantly have when you were one of the first to come out, and everyone kind of followed along, that we might not get cuts so far in this year because you have things like people refinancing their homes. You have companies who also refinanced when rates were low, and it's made an economy less immune to hikes. So put all those together, Torsten, that doesn't sound like a world that's getting back to 2%. That could realistically even get back to 2% if the Fed just holds things where they are. Is that the moment we're at?
I think that is a very significant risk, Danny, because exactly as you're highlighting, a lot of firms prepared themselves for higher interest rates by terming out their debt during the pandemic. A lot of households, almost by definition in the US, have 30-year fixed mortgage rates, so that's about 95% of all mortgages. So they are also therefore less sensitive to interest rates going up. So those things just meant that the transmission mechanism of monetary policy, in other words, the time it takes, the so-called long and variable lags that the Fed members keep talking about, was maybe not only the 12, 18 months that it was in what they normally discuss and what the textbook would predict. Maybe this just takes a lot longer time. And as that chart there you're showing is exactly highlighting, we have more than 50% of mortgages now that are below 4%. So the sensitivity is just not what it used to be. And that means that it needs more time before we achieve the goal. So exactly as you're saying, maybe the risk is that we just need rates higher for longer, which is exactly what we're pointing out.
Do we need something more severe than that? If you've got more than 50% with a mortgage below 4%. So the typical drivers of monetary policy are not as effective as they were. And you talk about even a huge swathe of America no longer having a mortgage. Therefore, if the transmission mechanism is not broken, it's just taking a lot longer to deliver. What else can the Fed do to slow the middle class? Because it is the middle class that's living off 5% CDs, their wealth is improving, the upper middle class. So what more must the Fed do? Is it just endure higher for longer than this market really anticipates, or something more severe?
Yeah, this is also really important, Manny. So exactly as you're saying, 40% of those who own a home, they do not have a mortgage. Think about that 40%. That means there's a lot of people when home prices go up who don't have any debt obligations and are therefore benefiting directly when you see asset prices, in this case, home prices, continue to move higher. So what can the Fed do? Well, obviously the textbook would say, well, the Fed can just raise interest rates more, but there's a number of unfortunate issues around doing that. Namely, if the Fed after now have talked about that the next move in rates will be lower, and they still, as we stand here today, have the prediction that we will see 3 cuts this year. Well, if that's the case, well, then it's really difficult to come out and say, well, we were wrong, we'll not get 3 cuts, maybe we need more hikes. So that's why, from a credibility perspective, it's just really difficult for the Fed to go and turn around 180 degrees and talk about rate hikes. So that's why I think that there will probably be a strong preference for saying, you know what, we will probably just keep interest rates higher for longer and let time do its work so that we ultimately get the result that we need. And that's why I still think that the market is wrong, anticipating that we'll get rate cuts this year. I still think that it's going to take a lot more time because also firms have just been through a period where they had much more freedom to set their prices at whatever level they thought was the right one. And that's why the risk is anchoring those expectations is probably going to take more time than what many people expect.
Torsten, I mean, one could look at some of the data and make the argument for cuts. Not saying it's right, but you could, for example, you could look at CPI slowing down. You could look at some of these companies saying that the consumer is weak. You could look at retail sales slowing down. But obviously, Torsten, part of the problem of that is that doesn't necessarily capture what you're talking about. People who own homes, the wealthiest of the wealthiest, who can still spend and can still buy assets. The data, though, Torsten, was built in a bygone era where the consumer, where the economy was a monolith. Are we making monetary policy and trading off of data that's no longer relevant and fit for 2024?
It's very correct, and exactly I agree with what you're saying, that the issue really here is that we have a bifurcated economy, and we're just not used to that in financial markets. And a bifurcated economy means that it is some consumers, namely those with most debt, that are hit by interest rates going up. It's some firms, namely those with most debt, enterprise software, tech, growth, venture capital, because they don't have any earnings, they don't have any revenue, no cash flows. And if that's the case, of course they will be more vulnerable to interest rates going up. Likewise, in commercial real estate, it's those skyscrapers, office, also multifamily that has the highest sensitivity to interest rates are those that are most levered. So we need to change our mindset in markets to exactly focusing on those balance sheets for consumers, firms, commercial real estate, where we have most debt. That's why high levels of debt is, of course, going to be more sensitive to interest rates going up. And that's what creates this bifurcated economy that exactly is creating these challenges where some balance sheets for consumers, some balance sheets for firms are experiencing distress as a result of Fed hikes, whereas others are actually doing just fine.
Torsten, when it comes to macro policy, today's actually a singular item. It is NVIDIA. That is a sentiment-defining moment. Danny and I have been touching on this with guests through the morning. So NVIDIA will come. It'll be a clearing moment. It'll either be the catharsis or a crucifixion on sentiment. But I want to get a sense from you as an economist. I went back to the year 2000, to Boston, to Greenspan, and this is what he said. Since 1995, output per hour in the non-financial corporate sector has increased at an average annual rate of 3.5%, nearly double the average pace of the preceding quarter of a century. You talk about the new inflationary forces of defense, of immigration, of louse financial conditions. However, my question to you as an economist, are we facing a Greenspan-esque paradigm shift moment in terms of what AI will do for productivity? That was a heck of a jump in those 5 years from 1995 to the year 2000. What thought have you given to this?
Yeah, this is really important because if we do get that jump in productivity, then we will get much more downward pressure on inflation. This is really crucial for the Fed, and therefore the parallels and the discussions of to what degree is this the same as the late 1990s is really, really important. And the ultimate question that we really all need to think about, which is so hard, is that the internet that came around in force in the 1990s, is that more important and has a bigger positive effect on the economy than AI? Or vice versa? Is AI going to have an even more revolutionary and more positive impact on the economy than the internet had in the 1990s? Or in economics language, is the productivity gains of the internet, are they going to be smaller than the productivity gains from AI? My opinion is that AI is not going to deliver the same productivity gains that we got from the internet in the 1990s, simply because the internet was spreading information. AI is to some degree doing the same, but it's just not the same tailwind from a macro perspective. And that's exactly why in this discussion about inflation and squaring our circle in our conversation here, you have the challenge that we may not get that huge positive effect where inflation is getting significant downward pressure from AI, the same way that the internet was in the 1990s.
Torsten, I just want to linger on that because that is quite contrarian. It's even contrarian to company after company that we've heard of that have said part of the reason we are spending now is to spend on AI in order to get our costs in check, that will ultimately help us. Do you think that there are a lot of corporates out there, as well as you're saying some of the economic views of productivity of AI that are squarely misplaced at this moment?
I actually do, because just think about what's been going on in markets here more recently. Last year, It was all about the Magnificent Seven. All 7 companies traded in a very highly correlated way. They were going up, all of them at the most of the time, because the story was they will all be benefiting. AI will do wonders everywhere for all companies and almost to the same degree. But think about what has happened in the last few months. Maybe it did matter how many cars Tesla was selling. Maybe it did matter how many iPhones Apple was selling in China. And that's, of course, the dramatic difference you've seen in performance inside the Magnificent Seven. Some of the companies are down 30, 40%. Some of them, including NVIDIA, are still up. So that's why if those that are still left standing with a bullish outlook, namely NVIDIA, Meta, several of the others at the high end of the meaning high-end performers of the Magnificent Seven, if they do not deliver today, it may be the final crack in the AI story that maybe this was not just that everything will be benefiting. Maybe it was important that we did our homework in public credit, in private credit, in public equity, in private equity, because we need now to figure out which companies is it actually that will be benefiting from AI. And that's a very different discussion relative to just saying, oh, all companies will be benefiting the way the things we're trading last year.
Yeah. And again, to your point, Torsten, speaks to the mispricing of a lot of things, if that is the case. Torsten, so brilliant as always. We always appreciate your time. Torsten Slok of Apollo. Okay, coming up, we're going to get back to the nitty-gritty of NVIDIA, a possible make-or-break moment, as Torsten was just talking about. That's to come on Bloomberg Brief.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. So, Manus, we're going to get more retail earnings coming in. Both Target and TJX report before the bell. Let's get over to our reporter, Bloomberg's Dasha Afanasieva, on this. So, Dasha, look, we've already had some retailers. We've had a lot of retailers. And this theme that we're continuing to hear about is prices being cut. You have issues for both Walmart and Target. When it comes to something like TJ Maxx, is what's good for a discount retailer good for the rest of the consumer?
At the moment, it definitely seems like that's the case. Target is slashing prices on 5,000 of its products. And if you look at TJ Maxx that's actually doing better than the rest of the retail sector. I mean, with sales expected to rise 3.4% in the quarter, you'd almost be forgiven for believing in the future of bricks and mortar retail and to think things are sound in that sense. Indeed, Target's Chief Executive Brian Cornell emphasizes that 2/3 to 3/4 of American shopping is still done in stores. So in that sense, the focus of the physical retail model is still alive and well. But Target is still expected to decline in terms of top-line sales today. And that's, they'll blame it on post-COVID normalization, and that is really a factor. But it's also the strength of the consumer and that shoppers are stretched.
And with that in mind, of course, yesterday we saw these 5,000 basic household items being cut by Target. Just last week, Walmart, I think the equivalent, I need to double check, is somewhere up around 7,000. All everyday items at Walmart are being cut. Now, Danny and I were debating this morning as to whether this was a reach for market share in that battle for the lower-end consumer who is under pressure from higher rates. We just had a conversation with Torsten Slok. Or is it something new in regards to the end of greedflation?
I think it's the first option, because those consumers are really stretched, and we've seen numerous consumer goods companies like Pepsi, Nestle talk about that lower end that's really struggling from a reduction in government stimulus, from having to restart paying back student loans, from really high inflation, really high interest rates. So I think that companies are now competing for that consumer, and they know that it's a promotional environment. And as you touched upon, sort of the danger is, of course, that you lose a lot of margin, but they've kind of made the bet that that maintaining market share is more important. And I guess in Target's case, I think they've already cut back costs in order to protect some of that margin. So they're sort of towing that line. I think also if we just mention Macy's and Lowe's yesterday, they actually beat estimates. So maybe it's too soon to write off the US consumer just yet.
No, we won't kill off the hedonism of the US consumer. They're certainly spending on credit cards. And I think, as Danny, we were just chatting this morning about delinquencies as well, weren't we, in terms of those credit cards?
Yeah, exactly. Delinquencies are high, but as Bank of America says, it's only one piece of the debt picture. So if you look elsewhere, it's maybe not as bad.
Okay, Dasha, thank you so much. Let's see what the numbers are when they come down. Dasha Afanasieva on the retailers. Coming up, we're going to talk Tesla. The shares are getting a little bit of a bite taken out of them this morning, losing ground in Europe. Context matters. Good morning from New York on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
trillion industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
You're watching Bloomberg Brief. I'm Danny Berger alongside Manish Krandy in New York. Let's get you set up for your trading day on this Wednesday. We're going to get some economic data. U.S. existing home sales hit at 10 a.m. And then the Fed's latest meeting minutes will be released at 2 p.m. All of that leads up to the only event we care about. It's NVIDIA's first quarter earnings. Manish, those come after the market close.
Yep, we'll talk about those in a little bit more detail. Some stocks to watch. You got at Tesla. European sales falling to a 15-month low. That's at the start of the quarter. The registration stopped by 2.3%. Urban Outfitters up 7.3%, extending their post-earnings gains for the first quarter sales beats, and Anthropology and Free People's Brands driving the momentum there. Lululemon Athletic is down 4.25%. The Chief Product Officer, Sun Chow, departs the company, announcing that Chow would not be replaced. Look, the main event of the day is NVIDIA. We're counting down to that. We're expecting huge volatility. I think, Danny, a movement of 7 to 8% potentially around the stock. Let's get to Matt Bloxham in terms of what we're expecting on the numbers from Bloomberg Intelligence. Matt, good morning.
Hi. Yeah, I mean, really two numbers to focus on. There's the quarter that they're reporting. We're looking for $25 billion or so of revenue. They guided to $24 billion. The street's already closer to $25 billion. And then it's about the guidance for their Q2, the forward quarter on revenue. And the street's looking for something approaching $27 billion. So I think they're the figures that the market's going to focus on, particularly that forward guide, something around $27 billion of revenue for Q2. And I think attached to that, then it will be then really focusing in on the CEO's commentary about the longer-term demand trend. Are they seeing healthy demand for AI chips? Are they seeing that demand diversify away from the big hyperscalers like Google, Amazon, Microsoft, towards kind of more enterprise and government customers? And they announced a tie-up with Dell earlier this week. It's really important to get that diversification of demand to sustain that really strong revenue growth into the future. And ultimately, this is a growth stock, so they need to be continue to sustain that revenue growth, for the next few years.
Matt, we appreciate it. Matt Bloxham of Bloomberg Intelligence. A lot is writing on this, Manish. We've talked about this, but just to linger over what Torsten Slok said, because I think this is fascinating, this idea that everything has been trading in a really correlated way. But that cannot last because AI doesn't benefit everyone in the same degree. No. So much is riding on NVIDIA's earnings, in part because of that everyone wins in this environment. It really can't continue.
I think, when we asked him, is AI going to be as what, if we look at the productivity gains of the late 90s, and I think this is interesting, Torsten sort of said the debate as to whether AI would deliver the outsized productivity gains that you had from the 1990s, and he's doubtful. He's not of that mind that you're going to get the same tailwind. When the internet happened and exploded across the world, that was an explosion of dissemination of information. This is something very, very different. But as he said, this could be the final crack or the beginning of a major crack in Mag 7. So that's the scale of what NVIDIA can do for sentiment.
And also what NVIDIA can do for sentiment is the last time they reported earnings, the S&P gained 2%. That's the type of big gain you see something with like a CPI, for example, Manis. So no wonder everyone talks about this as a macro event because it has the same magnitude as impact as macro events.
Absolutely.
Do.
I mean, the scale of movement, we're expecting potentially a 7 to 8% swing. So you're looking at $200 billion of a move. Dan will be on air for that. On surveillance.
Can't wait. Surveillance is ahead.
We'll tell you what happened tomorrow morning.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
The Fed is putting pressure on the economy, more pressure than frankly is needed to get inflation down.
I think the Fed wants alacrity of a decision one way or the other so they can get off the pot.
We've learned collectively how interest rate insensitive the U.S. economy in particular has become.
I would say the rates policy is definitely restricted.
I do think that they are restrictive, but I think it will flow through to the economy over time, and they can take out some insurance rate cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance coming into Wednesday at all-time highs on the S&P 500. 3-day winning streak, 24th record close of the year so far for 2024. And the main event of this earnings season is coming right up. A $2 trillion market cap. The name is up year to date by more than 92%. It can only be one name. Bramo, NVIDIA.
This is what Jim Reed over at Deutsche Bank called it. The most important macroeconomic event, or one of the most important events in the macroeconomic calendar. That is where we're at, where one name, one company can dictate the macroeconomic backdrop for an entire market, and that's today.
The Southside raising the bar once again, going into the numbers a little bit later on this afternoon. Barclays raising their price targets. Stifel doing the same thing this week, expecting what? Beat and raise, Anne-Marie, beat and raise.
Well, a lot of the question has to come out to, it's not about do they beat expectations by how much. The bar just continues to increase for NVIDIA that they need to clear. Catalyst Funds says this: to avoid a sell-off, the company will have the top profit and sales estimates by at least 15%.
Not just about NVIDIA this morning, it's about Target, or as TK would call them, Target. Target.
It's actually
Target.
Okay, Target is what people call
Target.
it because it's the upper sort of crust of that ilk of store, which maybe they want to get away from.
Target it is this morning. We're down by about 0.2% in the pre-market. This is the communication we've had from the company so far. So we're going to get price reductions on 5,000 goods. Look out for announcements around that again. I imagine they'll give us some more detail and colour on that in the release a little bit later this morning. But the quote that stands out, I think, for us all, we know consumers are feeling pressured. Just last week, Walmart executives, we're seeing customers trade into Walmart. Just yesterday, Macy's. Lisa, assuming customers will continue to be discerning. This is a theme right across retail.
The problem with it, and this is what I think everyone's struggling with, and frankly, the profound uncertainty that we have with the consumer, slowing but not slow, softening but not soft, the idea of more discerning but still spending dramatically. And that's really the key question, is how much is this really a statement on why some of these companies are shifting their product mix rather than sort of projecting weakness in their earnings? Mohamed El-Arian out with a piece 30 minutes ago talking about the risks with the Fed being so data dependent. And one of those, he says, is the concern of the data dependence Fed comes with the risk of them is growing. That a number of companies expressing concern about weakening consumer demand. And that is particularly the case for those serving the lower income households, where pandemic savings, all of that has been depleted.
So that's what you've got to look for earnings. So a little bit later this morning, in the next hour or so, we'll hear from Target. After the close, a little bit later this afternoon, we'll hear from NVIDIA. We'll also hear some Fed speak as well. Goolsby a little bit later, and the FOMC minutes a little bit later this afternoon too. Governor Waller, the standout. Lisa talked about it at the start of the week. The standout for me from the Governor Waller comments in the last 24 hours, the fact that he graded the last inflation report and only gave it a C+. A C+. For an inflation report that this market got very carried away with.
It's passing, but it's not great. Basically, nobody is happy with the C+, and that's the reason why he said that they need to see several more months of good data, not necessarily C+ data, but maybe C data, that can give them the confidence to cut. This was a theme, though, throughout all of the Fed speakers. None of them are comfortable really talking about rate cuts in the near future, with the idea maybe we're talking about maybe one this year. So I wonder how much the market comes around to this versus just sort of thinking they're just basically shooting darts at a dartboard with a blindfold on.
C+ stood out to me as well, because that is a grade that would be unacceptable to my parents. And he says, far from failing, but not stellar either. But what Claudia Sahm did yesterday in the confidence they need, what is that actually defined by? She said 3 months. Several more is what he says. This pushes the timeline well past the election, what I'm looking at, and definitely towards the end of the year.
Governor Waller and others on the committee seem comfortable with where policy is right now. Doesn't mean they're going to cut anytime soon. Certainly doesn't mean they're going to hike in the next few months. This line from Governor Waller yesterday, we're not seeing anything right now that looks like staying here for 3 or 4 months is going to cause the economy to go off a cliff. Would they respond to weaker data? Absolutely. Are they expecting it to fall off a cliff? No. Andrew Honhorst of Citi later on this hour, we continue to expect the first 25 basis point rate cut in July. July's just around the corner. June's only next week. What do we need to see between now and July for Andrew Honhorst of Citi to ultimately be right and we get that first cut just a month or so away?
That's my first question to him. How much do Governor Waller's comments change his view, given the fact that they've set the bar a lot higher, and given the fact that we're just not seeing it in the data? We don't have the luxury of 3 months of data before July in order to get that confidence. What kind of weakness would he have to see to get other people on board with that kind of view?
They're 3 of the big themes for us this morning. Let's turn to the price action and get to the scores on the S&P 500. Equity futures shaping up as follows. This is what we look like. We are negative by only 0.1%. In the bond market, yields are higher by a couple of basis points at 4.4335. I want to sit on foreign exchange just for a moment. We'll start with the euro, and then we'll move on to what's happening with sterling. Christine Lagarde, ECB president, saying this about inflation. We're confident we've got inflation under control. That's not what you're going to hear from the Bank of England after the print we got earlier this morning. That's not what you're hearing from FOMC officials either. The ECB, out of the big central banks worldwide, seems to be in quite a unique spot at the moment where they're able to commit to their next move and commit to this idea that they think they've got inflation, price pressure under control.
They also have the lack of a luxury of Germany that's been basically in recession, that basically you've seen a lot of pockets of weakness that have been dramatic. And that is either a luxury or not, but they're catering to that. And that's a more obvious area to cater to than, say, in the United States. The UK is in its own world of hurt because the economy isn't that great, but the inflation isn't coming down nearly enough. That's going to be actually a mystery to me, but Europe actually seems like less of a mystery, with the weakness offsetting some of that inflationary pressure.
Let's turn to the UK just briefly. 127.32 on sterling at the moment. We have got a stronger pound by about 0.2%. Inflation out early this morning, upside surprise. If you were looking for a cut in June, I think the bias in the City of London now shifting towards later on in the summer, perhaps even August. I want to return to Europe. Think about the growth policy mix in Europe. The growth policy mix was absolutely dreadful in the last 12 months. You talked about the recessions in certain countries. That was at a time when the ECB had to remain committed to high interest rates. Now you could make the argument, and Erin Brown of PIMCO is going to make that argument later on in the programme, so look out for it, that the weakness is behind us. And they're going to start cutting interest rates into the recovery in the Eurozone, which is why some people are starting to look at non-US DM equities. Look abroad, look to Europe.
They've been talking about that all year, and guess what? It's worked. I mean, if you take a look at the stock 600, it has outperformed the S&P 500 by a dramatic margin. A lot of people are also talking about the fact that now Europe is talking about industrial policy akin to what the U.S. is. They're going to be stimulating on both fronts. How much is that going to be the case?
So let's talk about industrial policy and the prospect of tariffs on the European automakers. That was the standout overnight. Just a little bit of a teaser of China's reaction potentially to tariffs that might come through from Europe.
And that's exactly what it was, a teaser, because the China Chamber of Commerce went to the European Union, went on Twitter and says it was informed about this potential move of tariffs by, quote, insiders. This would affect U.S. and European auto companies, Jonathan, those goods going into China. China's signaling that it's ready to unleash these tariffs as high as 25%. This just sets the stage for not just tit-for-tat Washington, Beijing, but for tit-for-tat Beijing, Brussels.
We've talked about this a few times, what Mercedes-Benz is saying on the record and maybe what they're saying behind closed doors. I wonder what Mercedes-Benz is saying both on the record and behind closed doors if this happens.
Right now you're seeing the shares decline, but to me, who has the bigger leverage here? Who's importing more cars? Where do Mercedes-Benz and BMW get most of their revenues, or 40% of their revenues? China, which raises the concern of retaliation having a bigger bite than even some of the tariffs, given what the imports are from China right now into Europe.
Well, the BMW chairman recently said, we do not want to shoot ourselves in the foot with these kind of tariffs, kind of warning the European Union. But Lisa, John, you brought this up a ton of times. What do they say publicly? Because they want that access to Chinese markets. And then what do they say behind the scenes?
Yeah, I imagine they want the walls up domestically, but at the same time, they want to maintain access to what's happening in China. Bottom line, can they achieve that? I've been saying this for a while. Can you continue to sit on the fence and entertain Chinese markets at the same time as maintaining a presence in places like Europe? I think it's going to be really, really tough for companies to do. They're going to have to pick a side. They're going to have to pick a side in the years to come. That's what a lot of people think.
How does Olaf Scholz say basically, hey, you automakers, you're going to have to deal with weakness while we try to put up those walls? I don't really understand how this is going to happen, and if they don't, what does that mean if the fact that China is overproducing so many electric vehicles at cheap rates, what does that mean for their auto sector long term?
A lot to talk about this morning. Let's begin by getting you some stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. UK inflation came in hotter than expected, in part due to continued price pressures at restaurants and pubs. It was just 2.3%. That's the smallest increase since 2021, but that's the upper end of where forecasts were at. And just yesterday, BOE Governor Andrew Bailey said that he expected quite a drop in the inflation prices. Nonetheless, investors have pushed back cut bets. Now less than 2 are priced in for the BOE. TikTok has told employees that it plans to lay off staff in its marketing and operations teams this week. That's according to a report in The Information. The exact number of job cuts isn't known, but unlike other tech giants, TikTok rarely conducts large-scale layoffs. But at this moment in time, TikTok is grappling with an uncertain future facing that law, which will ban the app in a year unless it divests from its Chinese parent company, ByteDance. And Barclays is the latest Wall Street firm to consider asking its workers to get back to the office 5 days a week. Some managers have already started warning employees to prepare for the daily commute, that according to sources. Now, the decision comes after FINRA announced a series of requirements set to take effect in coming weeks. That includes requiring brokerages to list some home offices in regulatory records. And that's your brief, John.
Danny, thank you. Surely I'm not the only one who read that story and thought this. There are people at banks that aren't in the office 5 days a week. That's still a thing.
Well, I think that actually there are certain places where that's their one selling point. But you're right. How many people are surprised by this, saying, really? They have to actually go to the office?
Well, what I love is that they're doing it because of FINRA rule change, not because, well, the pandemic's over. Get back to your desk.
I thought everyone was back in the office. Maybe that's just me. Sort of conditioned by my own brutal experience of being in the office every day.
You hated being at home. Come on.
Couldn't stand it.
Okay, so that's it.
Absolutely couldn't stand it. Up next on the program, Biden closing in on the swing states.
Folks, the threat that Trump poses is greater in his second term than the first.
I talk about him differently now because now the gloves are off.
The gloves are off. That's next from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities on the S&P 500, another all-time high close in yesterday's session. Equity futures right now down by 0.1%. It yields higher by 2 basis points. The 10-year 443.55. Under surveillance this morning. Biden closing in on the swing states.
Folks, the threat that Trump poses is greater in his second term than the first. It's clear that when he lost in 2020, and I mean this sincerely, something snapped in Trump. He just can't accept he lost. And he lost it.
The whole world is laughing at him. He's a fool. He's not a smart man. He never was. I talk about him differently now because now the gloves are off.
So here's the latest. Former President Donald Trump's lead in key battleground taking a small dip as President Joe Biden narrows the gap. The two are separated by no more than 2 percentage points in Michigan, Pennsylvania and Wisconsin, according to the latest Bloomberg Morning Consult poll. Jennifer Flitton of Invesco writing this. Like 2020, this presidential election will likely be decided by less than 10% of voters in the battleground states of Arizona, Georgia, Michigan, Nevada, Pennsylvania and Wisconsin. Jennifer joins us now for more. Jennifer, going into year-end, going into November, what are the policy options that the White House has left? What levers can they pull?
Well, I think they just did one this past week in announcing the release of oil reserves. They're going to have to try to find some way of affecting those prices that people are feeling when they go to the gas tank, when they pay for the food, when they're looking at their mortgage rates right now. The Fed isn't very helpful. And so this administration is going to have to do things that at least allow for the feeling of the economy loosening, right? For folks to feel like more is in their pocket. Because right now, compared to 3 years ago, everything just costs more.
Jennifer, one policy lever potentially the White House may pull again, they did this morning, and this has to do with student debt. Does that resonate with the electorate?
I think it depends on who is affected. And sometimes it actually sort of alienates those who don't go to college. We sometimes forget that there's a huge segment of the population of people who don't go on and further educate themselves post high school. And those blue-collar workers or small businesses, entrepreneurs sometimes, those folks aren't affected by that. And sometimes there's a disconnect between those who feel like they're paying for those student payoffs and those who are actually receiving them.
Looking at Michigan, Pennsylvania, Wisconsin, it is very, very tight. And our latest polling data shows that amongst a slew of other polls that have come out in the past few weeks. How critical are these 3 states to Joe Biden? I mean, can he even win without holding the blue wall?
Yeah, that's an excellent point. That is exactly what he has to do. I mean, his pathway to a second term is through the states of Pennsylvania, Wisconsin, Michigan, and then biting off one of those Sunbelt states. And it's sort of the reverse for Trump as we're looking at these polls, that his best route is probably through Nevada, Arizona, Georgia, and then biting off one of the steel belt, the northern states. So, you know, this is where their focus is going to be, and we're 166 days away from the election. We know it's going to tighten, and it's going to tighten further once folks really start focusing, which is when the kids go back to school in September.
Jennifer, a lot of people have been talking about not voting at all because of Israel policy. At least we hear a lot of articles about that. We hear a lot of people saying that vocally. Are we overstating just how significant this issue will be to getting voters out or keeping them home in some of those blue states, in some of those swing states?
Yeah, yes, I think once you do the crosstabs, I mean, you're going to find demographics, you're going to find people, you know, swing voters sometimes are those who are willing to swing, progressives, young people. These are folks who aren't necessarily going to go and vote for Trump, but they may stay home. They may have their vote depressed. And that really matters when you're in a state like Michigan, and you know, you're 10,000, 20,000 voters that you're really pining for. But I think the fundamentals of this election are still staying true, and we're seeing this in polling. It comes down to the issues of inflation and immigration, crime, and then on the other side, abortion and sort of that democracy chaos sort of issue on the Democratic side.
Is there anything the Biden administration could do around inflation, given the fact that it might be actually decelerating, but the inflation that's baked in isn't going to change between now and the election?
You know, some suggest that it may be about messaging and having a better message and looking forward to the future. But I think you've hit on the question, and that's the question that the Biden campaign are wrestling with, you know, sort of constantly, and they probably will up to Election Day, especially if our economic circumstances and the way that people are feeling the economy stay the same.
Jennifer, forgive me for the home bias, but I want to talk about financial regulation and the future of it as well. The head of the FDIC is stepping down. We can talk about the why. The bank lobby, or the common sense lobby, seems to have won out over capital requirements potentially being unveiled over the next several months as well. What do you think the future of financial regulation is going to be, regardless of who wins the White House come November?
Well, and I'll first say that Mr. Gruenberg has announced that he will resign, but only he'll step down only when his seat is filled by a confirmed new director. So, our chairman. So I do think that we may have a little more time with him. And then, of course, you know, the bank lobby, to your point, there is a real push to get a reproposal. And I think the FDIC and OCC would potentially just like to make some minor changes on the Basel III issue. But the Fed seems to be a little more open to reproposal. And you're going to see Congress continue to push on this issue. There have been some really interesting hearings where you've seen some bipartisan concern with the proposal and the request for reproposal. So I think this is going to continue to play out throughout the rest of the year.
Do you think we'll see anything substantial when it comes to this ahead of the election?
Well, if I had to sort of armchair sort of, you know, look at this issue as the likelihood of the time that we really have here in Washington prior to the election, I think it's unlikely. But I do think it's very possible that we see a reproposal. I know that many folks downtown and those who are on the Hill are constantly working to see that happen.
Jennifer, I know you focus on policy, and one of the biggest policy fights next year is going to be taxes as well, in terms of the financial umbrella. What are you expecting in terms of the extension of the Trump-era tax cuts? At what level do you think they get extended?
Well, and no matter who is president next year, you're right. In 2025, we have a number of provisions that are expiring from the TCJA, was passed in 2017. It's going to look very different depending on the makeup of Congress and the presidency. So much is riding on this election as it relates to tax. And so if you do have say it's a Trump presidency with a majority in the House, for a Republican and Senate, then you could have a much larger sort of reconciliation package on taxes, something similar to 2017 in its breadth, right? But if it is a Biden presidency and you have a split Congress, it's really going to have to be a negotiated package because you have a number of different provisions from SALT to the individual tax rates and tax child tax credits, those are all going to be part of the negotiation. So it's going to have to be a bipartisan package.
Jennifer, we're about 8 minutes away from the expected release of Target earnings, and this comes at a time when, just to go back to your point earlier, it's going to be really key at this White House to see what kind of messaging they can do to make people feel better about the fact that things are more expensive than they were 4 years ago, 3 years ago. The White House came out with this on Monday, basically calling on grocery chains to lower their prices, welcoming the fact that Target had lowered prices, saying they are delivering. Is this what will win when it comes to messaging?
Yeah, that's a great question. I think we saw this in the State of the Union, this whole idea of shrinkflation and sort of forcing the issue onto corporations, onto those who deliver services, onto those who deliver goods. I don't see that is where Americans are focusing their concern, and I do know that, you know, as far as institutions go, grocery stores are pretty high in the support of the American people. Institutions in Washington much lower. So I think that might be a difficult one to sell to the American people.
Jennifer, thank you for your input this morning. Jennifer Flitton there of Invesco. This is still the #1 issue, isn't it, going into November?
Well, looking through the poll data that we have with Morning Consult, the economy rates #1. And then when you ask respondents, name 3 things about the economy that you care about, prices of goods is still a concern. What's interesting about this is the Biden administration met with a ton of executives in October. The Target CEO was one of them. The Target is cutting prices because they see that they have to for their business, and so potentially you're seeing weakness in the consumer. The White House is trying to act like Target is cutting prices because of the outreach from the West Wing, which is not factual.
Well, let's talk about Walmart in the last week or so. Why is Walmart getting business? Walmart's getting business because of what they call trade down. And if you're thinking about trade down from what? From who? We're thinking about Target, which is why these numbers later this morning are so important. What kind of damage have the Walmarts of this world done to their model?
They might push back against Target and say, we want to be Target because we don't want to be the high-end model. I wonder if it's Target or I wonder if it's Whole Foods. I wonder if some of the people who are trading down are going from more expensive grocery stores versus a comparable type of store. But that's true. People are looking to be cost conscious, so they want to compete. You're raising skepticism. Maybe this wasn't because of the White House meetings. You can make your own conclusion, but this is what they're doing.
I'm guessing it wasn't because of the White House meetings. The stock is down by about 0.4% in the pre-market. Look out for those numbers, expecting them at some point this morning. Look out for David Malpass as well, the former World Bank president. Anne-Marie caught up with him in the last week or so in the Wall Street Journal. Just how busy things are going to be for the next administration. They've got to hit the ground running. The suspension of the debt limit expires January 1. This year's spending bills will likely be extended just long enough to kick the can into 25, and tax rates will rise at the end of 25 unless Congress and the president can agree to expend some of the expiring provisions in the 2017 Tax Cuts and Jobs Act. That was David Malpass in the Wall Street Journal in the last few weeks. So we'll pick up on that conversation later this morning. Coming up very shortly, we'll catch up with